All right, good afternoon, fools, and those of you streaming on YouTube as well. It's noon here on the East Coast. I'm joined by Brian O'Reilly. Brian, how you doing?
Good morning. Doing much better than yesterday.
Yeah.
I had some stomach issues yesterday, but I'm on full recovery mode now, so feeling much better. But yeah, it was a rough yesterday. I slept most of the day, so.
Yeah, well, good to have you back. Right, and it is. I guess it's still pretty early on the West Coast where you are.
Yeah. I got coffee.
But yeah. Well, we'll be here for the next hour, taking questions on any stocks. Well, really anything. But any stocks of the reported earnings this week. We have our theme here: weekly news roundup. I think a lot of the, certainly NVIDIA was a big story this week. I don't know if there was too much macro news. We had that I saw the PCE, personal consumption expenditures, which is the inflation report that the Fed prefers to track, was basically in line with estimates this morning, which tends to be good news. Tariffs, other geopolitical stuff, always seeing a lot of noise around that. So, hit us up with some questions in the Slido. The code is Fool24.
And the guys were talking. I can talk about biotech or healthcare in general. The guys were talking about SPACs in the last hour. And we actually had one go, biotech announce it's going public through a SPAC this morning. So Bridge Bio, with the ticker there is BBIO. They did a spinoff in 2021 of Bridge Bio Oncology, and so it was had private funding, and now is doing a reverse merger with Helix Acquisition Corp 2 to end up going public, and so you'll be able to buy the shares of that company. Well, you can buy the SPAC now, and eventually, once they close the merger, that'll trade as Helix, as Bridge Bio Oncology. So the company will have 450 million in proceeds, which is pretty decent size, normal IPO. So I can see why it still made sense for them to do it via SPAC. Obviously they're getting quite a bit of cash. The company is going to be valued at $950 million at closing, and then they had 100 million in cash. So that extra 450 will bring them up to 550. So only trading at an enterprise value of $400 million, but their clinical trials are at very early stage. So they have 3 drugs that have been named, and they're I guess they're all in phase 1 clinical trials or moving in that direction. So a very early stage company, and $400 million in valuation. I don't know, seems reasonable, but it's in the too early for me to invest in camp. But I'm definitely going to keep it on my radar. I really like the Bridge Bio pharma company. They seem to be doing quite well with the launch of their first drug, and so sort of an interesting move there rather than going public through an IPO. But again, I mean I know SPACs have a bad name, but money is money, so it depends on what you can get as the valuation for your stock, and it seems like they're getting a decent amount. They're certainly getting a decent amount of money, and I think that they're getting a valuation that seems reasonable, not undervalued. So I think that probably a good move for the company.
Yeah, maybe the SPACs are coming back from the dead finally. It's an interesting model for going public. Didn't do very well during the pandemic when we saw all those companies come online. But yeah, like you said, I think there have been some at least a few SPAC companies that are delivered decent returns.
Yeah.
I could take a question, recent question from Ed here. earnings season is winding down. What must happen for tech companies to move their share price going into the next earnings season? Yeah, I mean, I like this question. I mean, it's very easy as investors to focus on earnings. I mean, that's kind of the game. That's when you get the score and that sort of thing, I think. And we get those updates every quarter, but certainly stocks move in the intervening period. Heading into March here, we're sort of heading out of the peak of the earnings season and into a bit of a lull. But I mean, there's always news that can move these stocks. I mean, certainly, there's a lot of macro, level news. I think anything, the AI sector, if we're talking about that, or just tech in general, tends to be pretty economically sensitive. So, if concerns about consumer spending or inflation or that sort of thing start to sneak up again, I'd expect to see some pressure there. There's also, typically there's always industry conferences going on. One big one in March is the NVIDIA GTC conference. I believe at the conference last year, they launched the Blackwell platform. So it was a lot of news came out of that one last year. So that's a good one to watch if you're, if you follow AI stocks. I believe it's in mid-March. But yeah, and then, I mean, typically, the other conferences where news comes out, new products, guidance updates, could be really any, M&A rumors, analyst research, there's still a lot of puts and takes going into, what can move stocks in the sort of off earnings season period. Though, I think as investors, I still say, the quarterly results are probably the most important thing to track, and what's going to ultimately determine the stock's success over the long term.
So James asks about why does Fulgent Genetics, ticker there is FLGT, keep trending down despite decent earnings? So they released earnings this morning. The revenue was up 14% for their core revenue. So this company is a genetic testing company, mostly focused on basically all the different kinds of potential genetic tests that you might need to do, for everything from tumors to more obscure genetic tests. And they got big into COVID-19 testing when you had to go out and get had to get your nose swabbed and by somebody else, and then they would send it off to a lab and then get your results in 24 hours or something. And so as COVID testing has moved into the home through the antibody testing, their antigen testing, they've obviously have lost those contracts, and so they're not that's not their core business. But their core business was up 14%, and so it's 76 of the 76.2 million. 76 was the core business. So you can see how the COVID-19 testing has come down to basically nothing. $200,000 worth of COVID-19 testing, or non-core business, whatever, anything else that would fall into that category. For the year, core revenue was up 7%. So definitely a strong fourth quarter. But then if you go look at their guidance for 2025, they're looking for the core business to be 310 million, which is just over 9% growth for the year. So, and then they're still expecting to lose money. So I think the main problem with Fulgent Genetics, and the reason why, even though they're doing okay, I mean, the high single digit growth is good, but that big, they're expecting a non-GAAP loss of 65 cents and a GAAP loss of $1.95. And then they're expecting to have 780 million in cash on hand, and the market cap is 476 million. So they're expecting at the end of this year to have $780 million in cash, and they're only trading at a valuation of 476 million. And the reason why they're trading so much under cash is because investors are expecting them to burn all that cash, because they went and bought Fulgent biotechnology, which has very early stage clinical trial, clinic, drugs, and so now they're having to use that profits that they're making off of their genetic testing business to siphon that off, and instead of bringing it into, instead of growing the using it to grow the genetic testing business, they're having to siphon it off and use it for the biotechnology business. And so that's going to just naturally, investors know they're going to burn that cash, so they're not giving them the valuation based on that they're not giving that cash in the valuation, because they know it's going to be gone by the time that the company finally gets to be profitable. And so that's the reason why it keeps going down, or trades, it's trading like flat right now on the earnings today. And it's probably going to be dead in the water for a little while until they can get some decent phase 2 data, and so that's at least a year away, if not more. So it's just not one that I'm really. I mean, I like the company before they went and bought Fulgent Biotechnologies, but once they bought Fulgent Biotechnologies, it becomes a completely different company, and so it's not that interesting to me, based on the what they currently have in their pipeline. So
yeah, good rundown there. Sounds like some big changes over there. I'll grab this one about looks like Atlassian. Rita S 56 minutes ago says, can you discuss team? Yeah, Atlassian is a software as a service stock. They make collaboration tools. Some of them Jira, Confluence, Trello are some of the better known ones. They tend to cater to small and medium-sized businesses, so they have about 300,000 customers. When you serve the small and medium-sized, the SMB market, you tend to be more sensitive to the economic cycle than customers. Than the software companies focused on the enterprise level customers. So sort of potential risk in a downturn there. We were talking about some of these software companies yesterday. LegalZoom was one, Zoom as well. We talked about PubMatic, which is maybe more of an ad tech company, but a similar one. The market really loved these stocks in the 2010s, and we really saw them surge across the board. And Atlassian's still down pretty substantially from its pandemic era peak. It's one of these. I mean, this is very typical, I think, for the software sector. But revenue is growing. Still solid revenue growth. Looks like about they're targeting 19%, 18.5% to 19% in 2025. It was up 21% in their most recent quarter, but still unprofitable on a GAAP basis, which for a company of this valuation, 72 billion market cap, gives me a bit of pause. I mean, I know that we saw a wave of cost cuts and that sort of thing back in 2022, and there was some discipline kind of forced on the industry by that crash in tech stocks. But I mean, I think the company has a solid business. They're certainly seeing growth in economic expansion, and catering to 300,000 businesses. You're going to grow as they grow, and that sort of thing. But I think at this stage for the company, I'd really like to see some more cost discipline. They are sizably profitable, when you back out that share-based compensation. But yeah, I mean, they're on track for over 1.3 billion in stock-based comp this year. So that's taken a nice little bite out of profit. So yeah, I guess overall it's feeling pretty neutral about the stock. Would like to see that come down over the coming years.
Rick asks about my feelings on Recursion Pharmaceuticals. The ticker is RXRX. The company released earnings this morning, and earnings is, I probably put that in quotation marks because they don't have any drugs on the market. So it's basically just an update on the company and how much money they've lost and how much cash they still have around. So usually, I always want to go to the cash first just to see, how much cash they have. They have 603 million at the end of the year, compared to 401 million at the end of 2023. The reason for the $200 million increase is not because they got necessarily got revenue. The revenue for the year was 58 million, and that was due to collaboration agreement. So people, getting payments for doing research, but they probably raised some cash in there too. I would imagine, to get all the way up to 200 million increase, minus whatever they spent, right? So they've got 10 clinical programs, 10 and preclinical. So they're counting their clinical and their preclinical together. They have 1, 2, 3, 4, 5, 6 of those are actually in the clinic right now, and 2 of them look like they're pretty close to being ready to start the clinical trials. They're expecting to have 10 clinical program readouts over the next 18 months. So all that sounds really good, except that they're all early stage. So phase 1 or phase 2, or phase 2, and so they've so this is an AI company, and it's been really volatile. So it was at the beginning. Let's see, normalize this. So looking at the year-to-date chart, it's been up as much as over 50%, maybe 60%, and now it's up at about 11% year over year. So it had a big spike starting in February 10th, and then came back down to today's levels. There doesn't seem to be any news that really should have spiked that. I think there was some information that NVIDIA didn't sell any, NVIDIA owns some of the stock as they're helping, as they're investing in AI companies. And so there was news right around that time that NVIDIA didn't sell any of its Recursion Pharmaceuticals stock. It didn't buy any more, but it did sell some other pharma, bio healthcare companies. And so, I think, maybe that was good news, but this one just seems like it's really volatile and maybe hard to to value. And because it's such an early stage, there's not enough data from their clinical trial process to know whether they're able to create good drugs. Now, they can seem to be able to create drugs very fast using their AI technology, and at least 4 different large pharmas have signed on to help them, have them help them use their AI to develop drugs. So Roche and Bayer and Sanofi and the German Merck KGaA. So that seems like an endorsement, but how much money are those pharmas actually putting into them? They've earned $450 million in milestone payments from partners. And they have, in theory, they have 20 billion in potential milestone payments. A lot of those are probably in the commercial stage, and so they actually have to prove that the drugs work before they're going to get those payments out. But I'd like to see. I mean, the company seems reasonable. I mean, they obviously they're using AI, and that gives them some maybe a valuation that they shouldn't necessarily deserve based on their pipeline of early stage candidates, but they're going to read out quite a few readouts over the next 18 months. So presumably that's going to change the valuation and maybe right size it. Whether that means it goes up or down, probably is obviously going to depend on the clinical programs, and we don't know what those are going to read out because they're such early stage that it's difficult to know what they're whether they're going to be positive or not. phase one is sort of a crapshoot oftentimes, even if and then even phase two, if phase one was just testing for safety, then phase two is the crapshoot. So it just sort of depends. They do have some oncology drugs, and obviously the phase ones are definitely going to have efficacy readouts, but they have some other rare diseases that might not necessarily, might be more just testing on human, on healthy subjects, just to check for safety issues, and then moving into people that actually have the disease. So, I mean, I don't know. I don't want to be bearish on the company, but it's really, the valuation is wild all over the place, and so I don't know. I mean, it just seems like more of a day trader thing right now, and I'd rather wait until the phase two data comes out and it's easier to value whether, to figure out whether the value is reasonable. And I just think maybe they're getting a little bit of a premium for their AI aspect of the company, which clearly they can discover drugs really easily, right? But that doesn't necessarily mean that the drugs are good, right? And we have to see the clinical data to see whether the drugs are good. And so I'm sort of in the wait and see mode on Recursion Pharmaceuticals, and ticker again is RXRX.
I'll grab this one from Ali Al Abdouani. Question up here about Upstart. It says Upstart, your thoughts. Yeah, I was very impressed with Upstart's fourth quarter earnings report earlier this month. They've the stock has really been through the ringer over the years, big pandemic winter, and then fell off a cliff as that they lost the benefit of low interest rates and loan demand and that sort of thing. But what they've done is they came out with a new AI model, so the company uses AI to perform what they claim to be much better, credit worthiness and that sort of thing with a loan profile on borrowers compared to the FICO score. And their most recent model 18, really lifted their conversion rate a lot. And I think it's impressive to me to see a company like that making progress with its technology at a time where it's a macro sensitive story, but they were still able to deliver really strong results in the fourth quarter. So revenue was up 56%. Conversion rate improved from 11.6% to 19.3%. So, I guess we'll have to wait and see that, if the default rates kind of line up with their expectations and that sort of thing. But, assuming it does, I mean, that's really a huge win for the company to be able to convert nearly double the applications it was before. Their guidance was very strong, calling for $1 billion in revenue this year, adjusted EBITDA margin of 18%, and getting back to GAAP profitability. So I think Upstart is a company that potentially has a really strong technological and competitive advantage in this, and what's really a huge, they started off with consumer loans and expanded to auto loans. They're doing some HELOCs now, but if you can get tap into the mortgage market too, really it's a huge market that they can potentially tap into. So I think there's a lot of upside for the stock. I mean, I expect, I think it's still a high risk company, but very impressed with what they've done recently with that new model and those improving metrics.
So here's one that maybe we both can answer. The Foolist asks, they asked Danny and Rachel, but obviously they didn't get to it. So we'll change the title to Jeremy and Brian. May I know your 3 highest conviction growth stocks for the next 3 to 5 years? So I really like Humacyte. Ticker is HUMA. Very, fairly small company, but they just launched a new drug that it's artificial vessels. So the company is, so the what the company does is they have these tubes and they coat them with cells, and then the cells express proteins, and then they wash away the cells, and that's left with this proteins. So the proteins aren't immunogenic like the cells would be, so that the immune system doesn't go and attack them as being foreign. And then they can use these artificial blood vessels for when there's a trauma, like a big car accident, or somebody has a work construction related injury where they get a saw to their arm or something, some major issues where you got to connect the blood vessels back up so you don't lose the limb. And so that's what these are for. They seem to, what they would normally do is they would go and grab a blood vessel from another part of your body or your leg or something. But that takes time. And when we're in an emergency, this is, it's a big problem. And so these are off the shelf things. So you just pull them out of the refrigerator and they're ready to go. And the surgeon can reattach the blood vessels. So it seems to work well. They've got good data. They loaned them out to the war in Ukraine, and the Ukrainians were using them, and so they got some extra data from that, which should help eventually get sales, so help boost sales, because not only do they have the clinical trial, but they also have this extra amount of data that wasn't actually used for the approval, but they have experience. There's doctors that have experience in them with it. So overall, I like the company. There, potential additional opportunities to use these blood vessels as ports for hemodialysis, as put cells into them, and then use them as artificial pancreases, and then finally, eventually, potentially to use them for bypass surgery. So there's the other opportunities to for off the shelf products are these plastics, but the plastics seem to be much more likely to get infected, so that they seem to have some advantage there. If we're looking at a little bit larger company, they have one drug on the market and they're obviously not profitable. So that's pretty risky. If you want to go a little bit less risky, I think Moderna, ticker is mRNA, is a good option. They have two drugs on the market, but at least the two drugs are one of them is doing quite well, the COVID-19 vaccine, and they're expecting 1.5 billion to 2.5 billion in sales, and so that seems should support the valuation right now. And then they have a huge pipeline of early and middle and late stage mRNA treatments and vaccines. And so I think that they have, quite a bit of potential, and I like the valuation. I was sort of a bear all the way up and most of the way down. And I finally think that they've gotten into the reasonable valuation. So I purchased my first, small amount of it a few weeks ago. And if I can stop talking about it, maybe I'll buy another third. And then if we're talking about companies that are profitable, I think Vertex Pharmaceuticals for the next 3 to 5 years might be a little overvalued right now, so I'd probably try to look for a pullback, but that's one of my largest holdings. They have a great cystic fibrosis franchise. They have a pain medication that just got approved. It's a non-opioid. So hopefully that, just having the fact that it's in a new class and could take away some of the sales for opioid drugs, especially in the acute pain setting. Although eventually I think the bigger opportunity is in the long-term pain setting, where people have chronic pain, and that they have to do more clinical trials for that. And they got a kidney drug that looks like it's about, is either about to read out or is already read out. So they've got plenty of options for additional sales as they've sort of maxed out their cystic fibrosis, the whole franchise. They have multiple drugs for cystic fibrosis, and their sales are slowing. The growth is slowing because they're treating almost every cystic fibrosis patient, and so there's little upside opportunity in cystic fibrosis, but they have other options. But again, I think that one's just last time I looked, a couple, a week or two ago, it was a little pricey on the, if you look at the history of the company and the price to sales ratio, it was pretty far up there. It hadn't been that high for quite a while. So I think I would wait for a pullback before I added. If I was going to add more shares, I think I would wait for a pullback before adding additional shares. And I probably it's such a large position for me because it's grown organically that I may not even add if there's a pullback. But I think as a good starter position, I think it would make sense to add when you're on a pullback rather than adding right now. Any thoughts on high growth stocks?
Yeah. What was it? Three highest conviction stocks for the
sure.
For the next.
You can give them however many you want.
Years.
Yeah.
Sure. All right. Yeah. I like that question. I'll go with Axon Enterprise first off. So Axon does law enforcement technology. They're primarily known for tasers and body cameras and dashboard cameras as well. And then they have a pretty large and growing software business as well that helps police and other agencies manage records and evidence and that sort of thing. And I think this is really they've been one of the most innovative companies in technology, though they're kind of under the radar in that sense because they serve a niche there. They've gotten into drones. They've made a number of acquisitions over the years. So that they have a product they call Drone First Responder. I mean, basically what it sounds like: send a drone to gather information on a rescue situation or crime scene or something like that. A generative AI product that seems to be very popular called Draft One, which takes footage from body cameras or the dashboard cameras and writes initial drafts of police reports. So you're saving a lot of time, a lot of man hours, and that seems to be a real winner for the company with their customer base. Pretty innovative product. I mean, I think there's a lot of questions people have had about what can we really do with this kind of technology. I mean, taking generative AI and connect it to camera footage to do something like that, I think is pretty cool. They're growing very quickly. They've grown revenue more than 30% every year over the last 30 years. They also had a huge their biggest contract ever they signed in 2024 was with a global logistics company. So they're moving beyond law enforcement, their traditional strength there. And when you think about it, something like a body camera, if you're a FedEx or a UPS, or I mean, they didn't say the name of the company, but I imagine it's something like that. Why not give your frontline workers, your drivers, something like that? They'll record the package drop-offs, record any incident that might happen in the course of their work. So they're targeting more frontline workers in areas like that, or retail or security. So I think there's a pretty big market for the company to keep growing into, especially as they continue to innovate. Second company I'll go with is Mercado Libre. Mercado Libre, best known as for Latin American e-commerce and digital payments. I think this is another company too that they've just established so many different ways to grow, and their business is so interconnected. Still a large market to penetrate in Latin America. Not e-commerce and digital payments isn't really close to the penetration rate that we have here. they're issuing credit cards. They have point of sale machines that they give to brick or sell to brick and mortar merchants. They're have a growing ad business on e-commerce on the e-commerce platform. We've seen Amazon make a ton of money doing that. So I think Mercado Libre has similar potential there. So I think in some ways they've followed some of that Amazon playbook as far as that starting with e-commerce and building out an interconnected group of businesses from there. But doing some different things, certainly like with digital payments, and their growth really is very strong for pretty much every quarter. Unlike almost every other e-commerce company, they really didn't slow down very much after the pandemic, which tells me that they're executing very well and that the market is big enough that they didn't really see those headwinds that a company like Etsy or certainly like Wayfair or even Amazon was facing in the U.S., where people kind of started spending money on other things once the pandemic ended. And the third company I think I'll go with is Cava, the fast casual restaurant chain. I haven't tried the food yet, so
it's good.
I think I need to sample as a customer. Yeah, I know. I've heard good things.
Yeah, I like the first time I went to one. My kid had been traveling for AmeriCorps, and so he got experienced with it before it came to California, and then so we tried it, and it was like immediately I went and looked at the stock valuation, and it looked a little pricey back then. I don't know what it's at right now. This was probably 6 months or 8-10 months ago, but I think it definitely looks like a good, the one that's by us, the line's out the door constantly. We go and we order online, and it's still madhouse to try to pick it up and bring it home.
Yeah. Well, you're saying all good things there, and yeah, the stock has come down a lot. It's down, I think, close to 50% from where its peak a few months ago. So definitely a more reasonable valuation. But yeah, I mean, I've owned Chipotle for a long time, and I think Cava really has a lot of similarities to it's sort of like a young Chipotle with almost similar menu, just swapping out Mediterranean cuisine for Mexican. They do the roll ups like burritos or wraps, I think they call them, and bowls. Really just really strong results across the board. I think comparable sales was up something like 21% in the fourth quarter, which most restaurant chains would be happy with like 5%. So high average unit volumes, profitability is very strong. I mean, it's still a very small chain, but their margins and their metrics are almost at the kind of levels Chipotle's up at now. So I think they have about 360 restaurants. Their target for now is 1,000 by 2032. But I think given the popularity, I think and what Chipotle's done with, I think Chipotle now plans to have 7,000 restaurants in the U.S. I think a lot of upside growth potential for Cava as well. I mean, valuation still might be a bit high, but I think I think I like where they're going over the next few years.
And are they planning on doing the Chipotle version of rolling out where they're all owned by the company, stores that are owned by the company? Are they thinking about franchising?
Yeah, exactly. Yeah, they're all company owned too, which I think, I mean, that's certainly worked well for Chipotle, and with that kind of model, you don't expand as rapidly, but you do keep all the profits from the business, and you have more control over the restaurants as well. So I think, maybe for these higher end chains, compared to it's fast food like McDonald's, maybe that works a little better. You a little more control over the cuisine and that sort of thing.
Yeah, I think that makes sense. James asks, can we share our thoughts, or me, I guess, can share my thoughts on the risks and rewards of the shift of ABCL, which is AbCellera, is making from being a platform-based company to being a clinical stage biotech company. So this is a company that is, as the name implies, is big into antibodies. So AbCellera, the antibody, short AB is short for antibody, and then so they were doing quite, they're doing quite well, just helping other companies discover their antibodies. So they have a platform that is basically a research platform where they can easily screen for antibodies. Both, they've been sort of focused on a certain kind of a protein that they try to target for their antibodies, as well as developing bispecific antibodies that allow companies to develop drugs where one part of the antibody is attaching to an immune cell, and the other part of the antibody is attaching to a tumor cell, and then that allows the immune cell to attack the tumor cell and kill it. So rather than the immune cell having to go find the tumor cell and hopefully identify it as being foreign, this is basically bringing the two together and allowing the quick action to attract those two, to get that interaction going, and therefore move in the right directions towards killing the tumor. So they had, at the end of 2023, they had 13 molecules in the clinic and 87 partnered programs, potential partner programs, and that they increased the number of programs up to 96, so 10% increase, and the number of molecules that moved into the clinic went from 13 to 16, so that was a 23% increase. But they're now, additionally, they're developing their own drugs, and so they've got 2 drugs that have both been cleared for their ability to go into the clinic. Let's see, they've got one for an undisclosed target that's in the metabolic and endocrine space, and then they've got one for atopic dermatitis, which is a skin disease, and that one is also ready to go in the clinic. So the problem here is now, how do you value the company? So just like when we talked about with Recursion, and they've got all these potential sales milestones and development milestones, it's not really ever clear how quickly they're going to get to these, like, let's say they have a deal that gets them, $700 million in potential milestone payments. They don't disclose for reasons that are probably due to the fact that the company doesn't want to, when they're doing a deal with the next company, they don't want them to be comparing, and so they don't disclose when exactly those milestone payments are going to come up, and so that makes it really hard to value the company. So, and obviously they're not going to be making money off these early stage drugs anytime in the next 5, 6, 8 years probably. So you have to sort of base it mostly on their ability to generate cash from these partnered deals. And now, instead of putting all that money back into developing new technologies for their platform, they're using it to fund their clinical trials. And right now, early stage phase 1 clinical trials, not a big deal. They have plenty of cash, but eventually those, as they move into phase 2 and phase 3, they're going to need a lot of cash. They closed the year with over 800 million in liquidity. So they've got plenty of cash available, and I wouldn't expect them to not, to run out of cash anytime in the near future. So the question is just how to value them. And right now they're valued at $766 million market cap. And again, they had, find the cash again. They had $840 million in liquidity. So again, another company that's being trading at less than cash on hand. And the reason why they're doing that is because they know that they're going to burn through that cash well before they become profitable. And so the investors aren't giving them credit for that cash. And it's just another example of how, hard it's been in the biotech sector, that the valuations have just not been there, and that, there's not very much excitement for owning biotechs right now, and that's made it difficult. So I think it's, I think the valuation is probably reasonable at this venture, but I think it's the same thing as we talked about with Fulgent, that it's just, they've got this early stage pipeline that's going to burn cash, and they've got this other cash generating business that it's hard to value. It's probably arguably the AbCellera is actually harder to value than Fulgent Genetics. Is probably closer to what Recursion, which we also talked about earlier. I can't remember whether they were trading at less than cash, but again, they have all these partnerships with pharmaceutical companies to develop drugs, but understanding exactly how much value you should put into those drugs is challenging, to say the least.
Yeah. Yeah. Thanks for that. Take this one from a foolish investor about PubMatic. PubM is their hope. Yeah, pretty rough report. I think this is out last night, right? For PubMatic last night. So PubMatic is a supply side platform in ad technology. So they work with publishers to help them manage their inventory, optimize the ad revenue they're getting. But pretty ugly numbers here. So full year revenue is up 9%. Unfortunately, fourth quarter revenue up just 1%. So I don't know the precise reason for that kind of downturn in revenue from earlier in the year. The company did highlight some strengths. CTV continues to grow. It says revenue from fourth quarter CTV more than doubled year over year, now up to 20% of total revenue. They seem to have having some success with their supply path optimization, which is technology, sort of like it sounds, that helps buyers and sellers find each other more easily. Like a lot of ad techs, PubMatic is profitable. I think the thing that bothers me about this kind of report at this stage in time for this industry, we saw the digital advertising ad tech stocks really exploded during the pandemic. In 2022, everybody pulled back on ad spend because of this anticipating recession. We had a bear market, but we're well past that now. I mean, this is Q4 2024. Digital advertising, if you look at numbers from Alphabet and Meta, the two leaders there, very, very strong now. I mean, they went from near flat in 2022, now back to 15 or 20% there. So I mean, the digital advertising market is alive and well and growing. And so I think if PubMatic is struggling to grow in the current market, I don't think that's not a good sign for them. I think they're also losing market share, or they're being outperformed by Magnite, which is the other supply side platform ad tech stock. So that's also not really a good sign for them. So I guess there's always hope, I think, but it's hard to see a whole lot positive when the fourth quarter is the biggest one in the ad industry as well. So I don't know. I think you're trying to squeeze whatever the metaphor is, squeeze juice from a stone or something like that. With getting results from a company growing revenue 1%. So I mean, maybe we'll see that change, but after last few years of these kind of challenges, I'm not very optimistic about their business.
Jason, who's sitting backstage waiting to come on, says it's blood from a stone.
Blood, right? Thank you. Part of my brain not working today.
So, yeah, that's okay. I didn't know the saying. So RH says, asked 2 days ago, any thoughts on Eli Lilly? Ticker there is LLY. So the obviously big pharma company, high valuation right now, due simply to the fact that they've got a obesity drug that's doing quite well and growing sales substantially, and so that's allowed them to increase their that's caused obviously increase their revenue and allows them to have a lot of potential that allows them to create a lot of cash, which allows them to potentially either advance their own pipeline or more likely go and look for other companies that they could potentially in-license, either late stage assets or even things that are already on the market. I'm looking up the market cap right now because the last time I looked, it was pretty high, and it's back close to all-time highs again. I see. So valuation is at $809 billion. That's that's really high for a pharmaceutical company, even one that's growing as fast as they are, trading at 18.09 times sales in the fourth quarter. So that's usually we have pharmaceutical companies trading in the 10, 12 would be high, 15 would be high. So 18 is off the charts high. But of course, it's right now it's completely reasonable and not and fine because of how quickly their sales are growing. I'm trying to grab the quarterly revenue growth. Give me a second here. It's popping up. So revenue was up 44.7% in the most recent quarter. So that's just outstanding. You again, for a pharmaceutical company, usually if sales are increasing 10-12%, we're pretty happy. So 44% is off the charts crazy. So the question is it valued fairly right now for the next 5 years? It's valued fairly right now for its current growth. So the question is, what's it going to look like in 5 years? And is it fairly valued, undervalued, or overvalued for, let's say, a 5-year time frame? And I think the question is basically, it's hard to tell because it's, can it keep growing that quickly? One factor is, at some point we're going to get to the point where everybody who wants to try a obesity drug has already tried it and either been successful and it's lowered their weight to what they want, and they're on it. Maybe they've gone to a maintenance dose or something like that, or they're off of it and they're doing okay. A lot of people are going to go on it and then go off of it because they don't like the side effects. The GI side effects right now, nausea and vomiting and that sort of thing, are pretty high. And so as much as 50% of patients are off of it within the first year. Or maybe even less than that. So there's going to be a lot of people who try it and just don't want to try it again. So that, and then the third issue is that there's a lot of companies that are in phase 3 development right now for their own drugs, and so they're going to have a lot more competition. In addition to Novo Nordisk that they have right now, they're going to have quite a bit of other competition from multiple companies, including ones that have better tolerability, at least in phase 2 they did, and ones that have where they can be dosed once a month. So rather than injecting yourself once a week, you're injecting yourself once a month, and there's obviously going to be some good good opportunities for companies to take away market share from Eli Lilly for that. Now they have their own oral medication that's in phase 3 development. So I think if that one's positive, then we can sort of negate that, if that one, if the efficacy is fine and the tolerability is as good or better than the injected ones, then you could argue, well, they're, now they're back in the driver's seat because they've got a huge sales force that's already talking to doctors, and obviously they're doing well in getting it prescribed. And so, switching to an oral medication would even increase the number of people who'd be willing to take it again, especially if the tolerability is better. So I think that, I just think it's really hard to value Eli Lilly right now and know whether it's, a crazy valuation at the current valuation, or if it's, likely to continue to be able to grow at a 44% rate, in which case I don't know that $800 billion in valuation is crazy. It's probably not. I mean, it's probably can be the first $1 trillion trillion dollar pharmaceutical company if it continues to grow for a year or two at 44%. So that's, another 20% increase in valuation, more than 20% increase in valuation. So I don't think it's unreasonable to think that it could be a $1 trillion company in 2 years if it grows at 44%, maybe even before 2 years. So, that there's still potential for, solid growth from here. It's just that, whether they can keep that 44% growth or whether the growth starts slowing down is going to determine whether it's a value or not a value, whether it's a reasonably priced company or whether it's a value, it's a trap right now at the high valuation, and it's going to end up, coming down substantially and not being able to beat the S&P 500 over the next couple of years.
Yeah.
So sorry for my wishy-washy response, but that's what it is. Just don't know.
Looks like we've cleared the queue out for the last hour. So,
and we got some of the older ones answered. So I think we're doing good. I mean,
yeah.
Of course, if you got questions that you're interested in or you want Jason to talk about in the next hour, I think.
Yeah, I'll grab. I'm sticking on with Jason. So unless there's another one you want to cover, I can hit a question.
Okay, sounds good.
Yeah, I'll take this one from David Brooks. My favorite consumer stocks are TJX and Lulu. What are yours? It's a fun one. Well, I did just mention Kava, so I'll put that up there. Another stock that I think has been really sort of a steady surprise is Deckers Outdoor, the parent of Hoka. Really is what's driving the growth now, but they also own UGG. But yeah, I mean, I think they're wedded to the success of Hoka, but I think Hoka still has more room to run. They've well-managed company. The stock always pretty much always seems to be a pretty good price for their growth rate. I think they face some skepticism in the market, about the ability to keep growing, and they kind of keep beating estimates. So I think there's some upside there. Another restaurant stock. I think we saw. I think we've seen restaurant stocks go from maybe last decade. There were a lot of these sort of wannabe next Chipotle stocks, and a lot of them kind of, were flash in the pan, so to speak. And I think we're seeing better performance now. We have these new growth avenues in digital and delivery. Kava is one company that's benefiting that. I think Sweetgreen is also an exciting one there. Again, a small fast casual chain, unique niche with the salad, fast casual salad purveyor. They're also doing something pretty cool with robotics. They have Infinite Kitchen, I believe it's called, where basically an automated system that helps with restaurant prep. So they say that speeds up throughput, saves on labor, increases customer satisfaction. So they're adding that to more restaurants. So I think that could drive profitability, over the coming years for them as well. But we're at we're past 1 o'clock now. At least on my computer says 1:01. So I think Brian, I think we'll let you go.
All right, and I'll be on in a few more hours. I got 2 hours.
I think I'm on with you. Starting at 5. So I'll see you back in a few hours. But thanks for the biotech insights.
Okay, see you then.
See you, Brian.
All right.
Hey, Jeremy.
Jason, how you doing?
I am wonderful, my friend. I'm excited to be on. I'm beginning a little bit of a marathon here. I'm going to be on for the next 3 hours, fools. So hopefully you get a lot of questions for me. The good thing for everybody involved is I've got 3 different partners along the way, you and me here this hour. Jeremy, Andy Cross is going to be joining me. And then, oh my goodness gracious, Jeremy, I can't remember who's going to be with me. The mystery guest is going to be with me in the 3rd hour. So we'll do that. All right. So we're going to have fun. This is one that I've done this theme a couple of times. And I love doing it. And it's inverts, Mungerizing your questions. Jeremy, of course, the legendary Charlie Munger, the late Charlie Munger, is well regarded for his inversion principle of the idea of inverting things to flip them over, turn them inside out, and get to the heart of the matter. So we're going to try to do that with some of your questions in this hour. So you'll ask a question, we'll give the answer to your question, then we're going to invert that question and see if there's not something that can inform the answer in a more thorough way. You ready for this, man?
Yeah. I like this concept. And I think, inversion, I mean, we're here to talk about investing, but I think that's a good, mental construct for really, any problem or any question out there to kind of flip it around and look at it.
I agree 1000% with that. In life broadly, it is a wonderful construct. Like you said, I think that's a good framework. It's a way to think about it. All right. So we're in that lunchtime lull right now where people are coming back from lunch. They're a little tired, not quick to get questions to us, but anybody that's just joining us, you haven't sent questions into Fool24 before. The way you do that is go to slido.com. Your event code is Fool24, all one word. Get your questions into us. Jeremy, are we giving people individual investing advice?
We cannot, unfortunately. Yeah,
that's right. Well, you don't want individual investing advice for us. So number one, for lots of legal reasons and also ethical reasons too, we don't know you. We don't know your individual situation. We don't know your goals. We don't know your financial profile, your risk. We don't know any of those things. So even if we offered it, I wouldn't think you would want to accept it from us anyway. So the key is, this is not individual investing advice. But Jeremy, you know a thing. I know half a thing between the two of us, because it's one of those 1 + 1 = 3 kind of things. We know a lot and we can give some insights and some feedback, but people make sure and just use it to inform what you choose to do and don't do it because we said it.
Yeah. Well said there.
Thank you. All right. So I've had a chance to kind of scan through the queue here. Are there any questions you saw that you want to grab real quick while I dig in a little bit closer to a couple?
Let me go back. Maybe I'll grab one of the older ones here on Redfin. Talked a bit about that one yesterday with Jeff.
Yeah. It's interesting right now with Redfin because of the existing real estate market's a mess.
Yeah, it's been a real tough time for any of these real estate stocks, I think, and I guess I give some credit to Redfin for being able to grow. They did grow revenue 12% in the quarter. Still unprofitable, which is not surprising. I think when we talked about this yesterday, I think my biggest concern about the company is for a while we saw steady market share gains, which I think is what you want to see from a company that's putting itself out there as a disruptor, and we charge lower rates than conventional brokers and that sort of thing. That kind of stopped a couple of years ago.
Yeah, that's concerning. I agree. That's the concerning thing.
So, I'd like to see him get back there. Guidance was not very encouraging. I think that's why the stock's down. They're actually calling for a decline in revenue in the first quarter. I know Open Door saw some commentary from them. Open Door is the home flipping one of these online real estate companies. They said the macro conditions in Q1 have gotten even worse than they were in 2024. So I think we were hopeful that maybe with the Fed rate cuts and that sort of thing, we'd start to see mortgage rates coming down and softening, and if I guess I mean that in a good way, a recovery in the housing market, which I think really these stocks are going to need to deliver some returns for investors. So I
want to invert this one.
Yeah.
So the question is thoughts on Redfin earnings. So I'm going to invert it and say, what are the factors that are affecting Redfin's earnings going forward? I think because the question is, again, what do we think about how they just did? As investors, we want to look forward. What I'm going to do is I'm going to lay out the market, the industry that it's in. So I'm going to share on the screen. If I get our wonderful production folks behind the glass that really do the hard work, Jeremy, if we're honest, they're the ones that do the important work. So this is these two lines here. The purple line is existing home inventory, and the yellow line is single family home inventory. This is data largely from the National Association of Realtors. That is homes for sale, homes listed for sale. And you can see this goes back to 2000. And you can see the climb, and then right around here, I guess I can overlay on here the recession during the financial crisis. You can see, and really 2007 into 2007 is when the wheels started to come off, and this big spike is when a ton of people that had bought that second home, or even third home, or even fourth home in some outlier cases that they couldn't afford anymore, because so many people bought with those interest-only loans with the big balloon payments or adjustable rate mortgages. This spike was when the market got flooded with all this excess inventory and it started before the 2000s. It was really the late 90s where we started to see this run on buying extra real estate was the American dream and how everybody was going to get rich. And what happened right here was the market was flooded with houses that nobody could afford and nobody could buy. So that's why we saw this peak right here. And what we've steadily seen over the past decade is really when we've seen it. This decline is a combination of two things that have happened. One, I'm not going to lay it over the chart. I'm going to go ahead and exit the screen share. Just mentally picture that decline over the past decade. Ultra low interest rates. And this has really affected it more recently. And also we've started to see retirements of baby boomers that started to affect it. And a lot of people are living in place. They're not retiring to the Carolinas and all living in these active seniors communities. So there's a lot of inventory that's held up by older baby boomers that have retired they've chosen to not downsize. They have their life and their community is where they are. They're not looking to relocate. And we've seen more recently, Jeremy, you mentioned interest rates with a couple of, you're talking about Redfin, is a lot of people are now kind of trapped in the house they have because they can't afford to move up because they need a mortgage. And there's a lot of people who can't afford to downsize because they refinanced along that whole way, cash out refinances, and now they can't downsize without increasing their mortgage payments. So the key that I want to say is that the number is about 1 million homes listed right now, about 1.1 million homes listed for sale. That's about 2 months of inventory, 3 months of inventory. A healthy existing market is about 6 months of inventory. 4 to 6 months to sell a house. That's kind of been the average. We're massively undersupplied. That's the biggest headwind that Redfin faces. They can take market share, which they haven't been, but if, taking market share is good, but until something happens some catalyst happens that starts to free up this existing inventory, it's going to be really, really difficult for Redfin going forward.
Yeah. I agree with that. Good walk through there. Yeah. I mean, I feel like, going back to the, financial crisis, it's almost like the housing market has been traumatized from that event.
Yeah.
Now we're,
well, it did. I mean, it affected an entire generation of buyers that it pushed probably 5 years further down the road before they were able to even buy their first home. So it's definitely had some implications.
Yeah. You're right. The lock-in effect is very real.
Right.
Right now.
Yeah. It's funny. I was having a conversation with a good friend and I joked, but I think I'm serious. The town that I live in has gotten extremely expensive housing prices. I don't know if I've lived here for almost 3 years. I don't know if I could afford to live here if I didn't already live here. It's a high quality problem. It's a high quality problem. And I definitely feel for anybody that's not in this situation. So we got a question this just came in from Fourth Horseman a few minutes ago, and I want to stick with it since we're talking about Redfin. Redfin has $124 million in cash, and they're guiding for about $90 million in losses in the first quarter. Will they have to raise cash with stock or debt? How big of a risk do you see there? So have you had a chance to really dig into Redfin's balance sheet yet, Jeremy?
Yeah. So it looks like they have, they have $125 million in cash, then another 150 million loans held for sale. About half of they've got about $1 billion in assets on the balance sheet, but about half of that is goodwill.
So I'd like to look at working capital for companies like this. So working capital is current assets, which is cash, highly liquid investments that can be turned into cash really quick. Inventory, which that's not a big thing for Redfin. It's like things you can it's either money or things that you can turn into money fast.
Accounts receivable is about 50 million for them.
Yep. So, and then minus current liabilities, which is things that you have to pay for within the next year. And their working capital is like $43 million. So it's not a lot of working capital.
Current assets minus current liabilities, right?
So yeah, so working capital current assets minus current liabilities, about $43 million. That's not a lot. But again, we're talking that's cash. My guess, I haven't looked at the specifics, but that $90 million in losses they're talking about is not going to be all cash.
Yeah, that's GAAP. Right. They're guiding the EBITDA loss of 32 million to 39 million. So sometimes you can use that as a proxy for cash flow.
Yeah. Especially when it's adjusted EBITDA, because they'll be backing out like the stock-based compensation, things like that aren't actual cash money. So yeah, I think that's probably fair, is that cash loss is going to be closer to maybe their working capital, but there's ways you can kind of work with that working capital number, and it changes every transaction that happens every single day affects your working capital. So do you think they're going to have to raise capital?
I mean, I think it's a good concern to bring up. I mean, I think with the way the numbers are going, I mean, they had a free cash flow loss of about 43 million last year.
Mm-hmm.
So yeah, it's definitely a possibility.
Yeah. Is there a way we can invert that question? I got an idea.
Yeah. Okay.
With the negative sentiment based around the market, the environment that it operates in, its market selling homes, and the potential of a cash crunch on its balance sheet, do you see an opportunity here?
Without help from,
just as an investor?
I mean, I think they do need help from the housing market. I mean, I think there's always opportunity for, stocks like this that reflect, I mean, I think the price current price reflects a lot of the risks in it. You know, I don't know I believe the market cap's less than $1 billion.
Yeah, no, I mean, today's brutal. What's the stock down today? Another 14%. It's less than $7 a share at this point.
Yeah.
My answer to that is kind of along the same lines. Is like, I mean, there's always potential opportunity.
Yeah.
But the question is how much of the risk is priced in? And I would be willing to say if you're optimistic, probably a lot less than you think. Is what I would say is there's a decent probability that investors at this price 5 years from now, assuming the housing market normalizes some, will make money. But I think there's also a decent chance that you lose at this point. There is a massive amount of uncertainty because they're operating in an uncertain market, losing money, potentially relying on the generosity of others, right? Having to go to the capital markets to get some support. So that's concerning. Yeah.
Yeah. It's not a great place to be in where you're relying on, macro level tailwinds to appear, just when you need them. So,
yeah,
I mean,
that's right.
I one of the more colorful CEO quotes I've heard recently too. I think it was just a few quarters ago from Glenn Kelman, who's the CEO there. Who's pretty entertaining. One of the analysts asked him, basically, what's the plan if mortgage rates don't come down? And he said, well, plan B is to drink our own urine.
That's him saying, well, we're in the middle of the ocean and we're about to run out of water. Yeah.
Right. So,
Glenn Kelman is actually one of my favorite CEOs.
Yeah, I like him too.
I deeply admire him. The residential real estate market has been a ride the past 10 years. It has been a ride. And he's been faced with some really challenging decisions, like all of these other platforms that jumped on the iBuying market and tried to use that zero interest rate capital to try to get into house flipping. They tried, and they were one of the first to get out of it, though. And I think for good reason, because interest rates went up and the math became very unfavorable. And a lot of investors were convinced the company was going to become insolvent, was going to have to go through bankruptcy to emerge from that. And I looked at the balance sheet at the time and the potential risk with the assets that they carried and the debt and put it all together. And I actually aggressively bought shares when everybody else thought it was going to be in a lot of trouble. And it worked out. It worked out. Honestly, I sold most of those shares in the fall. I've kept a small position because the stock skyrocketed. That risk essentially proved to not be a substantial risk. The risk that it faces now is a little bit different, though. So I'm not looking to buy shares of Redfin right now. I'm not selling the very small position that I'm holding. I want to see how they get through this environment before I even think about that. All right, see another question you ready to grab?
Yeah. Well, let's see. We just got this question in from on Reddit. David Seisel says, "How much lower do you think Reddit will go?" Yeah, Reddit's been a very interesting stock to follow. I think people know it as a social media platform, but really they've emerged as this unique play on AI, whereas they have. And when you think about it, it really does make sense. I mean, they have this massive, what they call a corpus of content that they're licensing to, AI companies like OpenAI and those kind of businesses to train and run their large language models. So That's driven a lot of growth for the company. I do wonder if that's really a long-term. We've seen some concerns about large language models reaching, starting to reach these scale limits. As far as what they can do. So I don't know how much of a long-term growth opportunity that is for Reddit. I mean, I know they've added more advertising lately, but I don't, it's not the kind of platform like an Instagram or a TikTok that really lends itself to advertising as well. I mean, it's not dynamic, it's all written language. So, it's a bit of a puzzle to me. I mean, I think as to the question, we could try to invert it. I mean, I think it's going to be a volatile stock. It's hard to say. Really, I think no one really knows short-term pullbacks and that sort of thing when that's going to end. I mean, stock had really soared earlier. So I think they're sensitive to the broader economic winds and that sort of thing.
Well, yeah, because I mean, at its core, it's the one thing that it does have in common with Meta is it's an advertising business, right? The platform, you monetize it with ads. Long term, that's like you said, that's probably what's going to generate the most of its cash flows. So it's going to be reflective of the ad market largely. That's the market that it's tied to. And it's been a pretty good ad market if we looked at Meta's results over the past couple of years. So the inversion of this question, because the question here is asking something that we can't reasonably accurately predict, right? What's the stock going to do? How much lower do we think it can go? Is going to be tied to the performance and the expectation of the results. So I think that's the thing to do. The inversion of this to me, Jeremy, and I'll ask you because you know the business a lot better than I do, is again, thinking from a risk reward perspective and less about trying to buy the bottom from where we are today with what we know about the business, where the stock is priced. Is this an opportunity to buy?
Yeah. I think that's a good way to look at it.
What's the answer though? That's the, and I know it's a little bit of an unknown too, because Reddit went public to raise money, partly because some of its VC backers were ready to turn that investment into money, but also to leverage the capital markets to bolster its own balance sheet for funding its growth plans. What do you think?
Yeah, well, I will say that I remember reading the prospectus when this company was going public, and they had been they've been around for 20 years or so and hadn't made a profit and all this stuff, and they're kind of promising we're going to be an advertising business and we're going to be this AI content licensing business, and they see going from there to doing stuff like e-commerce, and I was skeptical of it, and I think. So far, I've been proven wrong, and their growth numbers have been outstanding this year. I don't know. I'm still leaning to thinking that this growth rate will fade, but. Having said that, having already been wrong about the company once, I don't know. It's such a unique business model, I think, in that content licensing sense that I think it's it's hard to know what kind of company to compare them to and what the really what the market opportunity is there as well. So
yeah, no, I think that's fair. It's to me, I think it's a little bit in the too hard pile. Based on, and to me, I kind of base it on when Twitter was a publicly traded company, how difficult it was to monetize a very popular, very engaged platform. My experience, with Twitter for most of Twitter's existence, and especially when it was a public company, as a user was extremely positive. Very useful, lots of engagement, easy to find things, easy to find people that are experts in the things that you're interested in, whether it's investing or sports or business or whatever, right? So, but even with that growth of user base and a very engaged user base, one of the main reasons the company went private was we can't monetize well. The markets, this is a constant struggle to monetize. And my concern and why I've kept it in the too hard pile for me and why I haven't bought Reddit, despite the fact that I love the platform and it is very engaged user base. A lot of the same things in different ways. It's deeper than Twitter. But how effective will they be at the monetization? So yeah, kind of there too. All right, what's next here? So fourth horseman asked a question that there's a lot of ways we can kind of turn this one inside out. This is kind of shifting away from the individual stocks and touching a little bit on macro and the political environment, the geopolitical environment. Fourth horseman asks, how are you guys thinking about the current volatility, whether market, geopolitical, sector, personal? So I'll start, and I'm just going to directly answer. I'm not going to try to put my Charlie Munger hat on here. But this is the sort of environment where your personal thoughts and biases, whether it's politics or just your psychological wiring, like one of the things I talked about this morning when I was on, Jeremy, is like I'm wired to expect a recession. I always it's going to happen. There's going to be one this year. I say that every year. I'm right about 1 out of every 9 years. We just don't get recessions very often. So I'm mostly wrong. So Peter Lynch, one of my favorite Peter Lynch quotes, I'm going to paraphrase. I can't remember exactly what he said, but if you spend a minute every year thinking about macroeconomics, you've spent 45 seconds too much. And his point is not that it doesn't matter. It's that it generally doesn't inform useful investing outcomes, right? So when I think about the macro environment, particularly the impacts of the geopolitical things with tariffs, there's a question in here asking, we've got tariffs with our border neighbors that are, as of right now, and as we've learned so far in President Trump's second administration, things can change really quickly. But with our border neighbors that are set to go into effect, I think Monday, things can change really fast. Things don't always have the implications you expect. And the market is typically very, very forward-looking already. So a lot of times these things are largely kind of already factored in. But I think the biggest way that I think about these things is accepting the reality that the market is going to bear what it's going to bear. If I buy the best businesses and hold them, they're going to bear better than the market. They're going to help me get my financial results, meet my financial goals over the long term. But I can't necessarily control whether that's going to be 14% a year like we've seen over the past decade and a half, or it's going to be 7 or 8% a year like we've seen in other periods where the market has underperformed the long-term averages. So just kind of accepting the fact that the market is going to bear what it's going to bear. And in the near term, with the volatility and all of those implications, you just have to invest through that. And I said something else I've said probably 9 out of 10 times I've been on Fool24, because we've had a very volatile environment pretty much since this experience has existed, Jeremy, is if you're worried about how your stocks are going to do in the short term, you're worried about the wrong thing. unless you need to turn those stocks into money in the near term, because you need the money to pay for your life. If that's the case, worry isn't the problem. You have an asset allocation problem. Stocks are terrible short-term investments because they are so volatile and unpredictable in the short term. Even though you can't get the returns, we're coming off 2 years of 20+% gains, like to the best 2-year run the market's had in a couple of decades here, Jeremy.
Yeah.
If it's money you need in the next few years, you don't need to own stocks with that money. It needs to be money, right? Because you don't know what's going to happen. You're reaching for returns when you need to be protecting against losses and giving yourself some predictability. So I try to separate my personal thoughts from this as much as I can, because it can be so damaging to reaching your long-term goals. What about you?
Yeah, well, I think you're right that on one level, it's really a question about a time horizon, which is going to be different for every investor. And if you're right, I mean, if you need the money that is invested, in the next few years, then I think, right, you might want to reconsider asset allocation or something like that, or it's a different problem than it is for a long-term investor, or somebody who's got that money in there for 10 or 20 years saving for retirement or whatever. But I do think that, volatility, I think I read this in a Sean Williams article, or I don't know if it's his original thought, but, volatility is the price of admission in the stock market. So I think it's, the stock market's always going to be volatile. Every day it moves, and, it's like, you hear on the news, the Dow's up 0.6%, usually there's no real good reason for these day-to-day movements even, but it's the nature of the beast. I think with volatility, I think if you are in the market, looking for stocks to own for 10 to 20 years, then these pullbacks are good. I mean, I agree with Warren Buffett, that the stock market is expensive now. It's hard to find good deals. It's hard to really, there are a lot of good companies out there. Most of the prices are pretty expensive. So, if you are a net buyer, if you're still investing cash in the stock market, I would think of that volatility as a positive, as something that you can take advantage of. I know it can seem scary. It's not fun to look at your portfolio and see a whole bunch of red. But as you mentioned, we did have 2 pretty phenomenal years. So
right. No,
it's a bit of a yin and yang there. So
it is. No, I think that's exactly right. So, all right. So we've got, do you follow Nanox at all? Ticker NNOX?
I don't really.
I can talk a little bit about this. Ed asked this question a few minutes ago. I think it's really interesting. I can answer part of this, and this is a good one to invert. So Ed asks the following questions: is NNOX, it's Nanox, a stock with a future? Does the technology work? If it does work, will it be difficult to convince hospitals and medical centers to switch over? So there is some evidence that the technology works. They're still in the process of trying to get approvals for everything that they say that it can do and get expanded approvals for it. So what I want to do is, if it does work, will it be difficult to convince hospitals and medical centers to switch over? I want to invert that and say,
what would stop them?
What is the thing that will prevent potential buyers from buying? And when it comes to healthcare, I don't even have to say this about healthcare. I think broadly, incentives matter. Incentives matter greatly. And when you're talking about changing an entire operating and economic model for doing something, that's challenging. So their go-to-market model is, we're going to install the equipment. You don't have to make this capital investment. And imaging equipment can be extremely expensive. Medical imaging is extremely expensive. So they're saying, we're going to put the machines in. And we're going to do it as a service where every time you perform an image, we charge a fee, right? We charge you a fee for that every time you do it. So, so that's their model. So that's a very different model to come to the market with, I think, than most of the imaging that's done. So I think that's a big hurdle to try to get over, to change that model, to basically move this from largely from a capitalized expense to an operating expense. So that's going to be really difficult. I'll give you an example of a company in healthcare, and the name is, as it always does on Fool24, the name is eluding me. The company that makes the little biopsy replacement patch for potential skin cancer.
Oh, is that DermTech?
DermTech, right? So DermTech's technology is proven and apparently incredibly accurate, much cheaper than biopsy, far less invasive. It's a little sticker, goes over a potential spot. You leave it on for a certain amount of time, remove it, and it removes some of those cells. You send that in, they run the labs from that sample. So why in the world would you not do that? You don't have to have an incision made and stitches, and it's cheaper for your insurance company. It's faster for your provider. Well, doctors that do that, pretty big revenue stream for them is doing biopsies. It's an important part of their business model. So you're asking them to change their business model around this in a way that's not good for their business model because it affects their cash flows. So incentives really matter. And it's less clear that Nanox's imaging technology is enough of a game changer and that their economic model that they're proposing will work. Morgan Housel has also talked a lot about, volatility being the price of admission in the market. And Morgan Housel has also, I remember him writing about hedge funds that, have what they call the 2 and 20 model, right? Where you charge 2% of assets and you have a threshold and hurdle rate, and any returns above that, whatever that threshold is, the hedge fund gets 20% of those returns. The remaining 80% goes to the investors whose capital it is. And one of the things that Morgan has talked about in the past is there's been multiple times that people have started a fund and offered a different fee structure or a lower fee structure and quickly just gone back to that standard 2 and 20 model or whatever version of it the particular area where they specialize in is, because they found they would spend more time explaining why they were doing something different and dealing with skeptical investors than people that were interested in lower fees. So incentives really matter. And when you're trying to do something different that looks like it's cheaper in an industry where there are very little incentives to be cheaper, you're often faced with skepticism, right? And I think that's one of the things that Nanox is gonna continue to have to face.
Yeah, it's a very good point about incentives in the healthcare industry, right? It's like the as far as the doctors or the hospitals are concerned, they're not trying to save the insurance company's money or
right
or you.
They have a staff. They have a staff to employ. They have bills to pay. They have yachts to buy. Right. So that's my poke at doctors. That's the one. It's the only one I'm going to make. But it's more broad than that. Incentives matter so much. Look at everything that happened with Wells Fargo. Right. This went from Warren Buffett's favorite bank to a bank that is not on the Berkshire in the portfolio at all anymore, because the incentives for their frontline employees were so negatively incentivized. What's the opposite? What's negative incentive? What's that? You're being punished, right? If you're not growing accounts,
right?
It's bad. It's bad not growing accounts. So what did they do? They opened accounts that people didn't want or know they had. They committed fraud, right?
Right.
So incentives really matter. So,
yeah, very true.
We got 19 minutes left, and we got some questions.
Yeah, I'll grab one. I saw this one from Audrey Ritterman. What do you think of Planet Fitness stock for a long-term investment? Yeah, Planet Fitness is it's not one I've looked at in a while. I see their recent earnings report here, but they were doing well for a while. I mean, I think it's a good business model. Their franchise. I think most of you at home are familiar with Planet Fitness. Maybe if you haven't actually worked out there, but you've probably seen it.
Most of their members haven't worked out there. Who are we kidding?
And I know, right? Yeah. It's the magic of that gym membership model. I was a Planet membership, Planet Fitness member once upon a time. But yeah, I mean, from a customer perspective, right? I mean, it's $10 a month. The gyms are perfectly, serviceable and functional. They got all your standard equipment, so it's a great deal for customers. Planet Fitness also they franchise, so they're collecting mostly franchise revenue,
right?
And they do compete with some other low cost gyms, but
like Crunch Fitness and others. Yeah,
I'm pretty sure they're the biggest by now, and they've grown to about 2,700 locations. They're targeting 5,000 locations over the long term. I think as an investment, and they're still delivering steady growth. I mean, I think this is one of those that, it's a good, steady business. I think at the current valuation, looks like they're trading at price to earnings around 46. I think for that valuation, I don't feel, I think it could perform, match the market performance. But I don't know if I see a real outperformance from them. But I think, that doesn't take away from the business itself. It's just,
I think it's definitely built. You talked about, using the franchise model and that sort of thing. So the upside of that for a business like gyms, I think you should be familiar with the fact that gyms, like, they close a lot, right? It's a tough business. You have a lot of fixed operating expense, like all the equipment you see in a gym for the most part.
Yeah, definitely.
They don't own that equipment. It's leased, right?
Yeah.
So that's a lot of fixed payments to have to make, every month or every quarter. Minimum staffing. Generally you want a gym to be in a high traffic area because you want people to see it. Marketing the gym is the most important, hardest thing to do because the membership churn. You're running on a treadmill. To apply a gym framework to the way to think about it. You have to run really fast just to stay in the same place, right? So the best real estate's expensive. A lot of gyms fail because the mistake they make is that they go cheap on real estate and they're back in some industrial park and nobody sees it. Nobody ever goes because they don't know where it is. They don't think about it. They don't drive by it, right? So they want to be in highly visible places as a marketing tool, as a convenience tool, and it's challenging. So when you pass on that operational responsibility and risk to an entrepreneur who's the franchisee, you pass along some of the cash flow to them, a lot of the cash flow actually, but you also pass along the operating risk, and you can get really good margins just those franchise fees, right? Mm-hmm. And you help with the marketing, right? They're part of the big national brand, and they help a ton with. Go ahead.
They got their New Year's Eve,
Yeah. Right.
They blanket Times Square every New Year's.
And the goal, it's funny you say it, and the goal is, like, part of their business model, frankly, is being cheap enough that when people quit, they don't cancel. Right.
Yeah.
That low monthly price is low enough that they hold the option to go to the gym. Right. It's like somebody says, and I'm the worst about this, Jeremy, my wife will say, we're going to go after you. Where do you want to go? I want to go somewhere healthy. I'm not going to order anything healthy when we get there. I promise. I want there to be healthy choices on the menu, right? That's, and it's kind of the same with the gym, and maybe I'm sounding a little cynical, but it is one of those businesses where the best, most profitable gyms are the ones that are never very busy, but they're busy enough.
Yeah. There's a sweet
right?
spot there where I
Yeah.
forget what the math is, but they count on, they only count on a certain attrition rate or a certain percentage of members not showing up.
Like half or more of your members not showing up, but staying members. So
right.
Yeah. All
Yeah,
right.
it's a unique business model, I guess, in that sense.
It really is. I'm the worst, by the way. I'm the worst gym cheapskate in the world. We have a local gym that we're members of that we pay for. And I'm there once a week, sometimes twice a week. But I have 2 friends who are members of another gym. They're one of these discount gyms. I will not disclose the name because I don't want to get blacklisted if an executive for that gym's watching our show. But one day of the week, I go with one of those friends because he can take a guest. And another day of the week, I go with my other friend to the other one because he can take a guest. So
right, yeah.
I'm freeloading. I'm like the entire opposite. It's smart, right? It is smart. I'm mongering here. I'm inverting. Like this is the inversion of what gyms need. They need people paying and not showing up, not people showing up and not paying.
Yeah.
So, yeah. All right. Can I grab Ed's question here about Realty Income versus a couple of the Brookfield subsidiaries?
Sure. Yeah.
So Ed asked, in your opinion, which is the better investment? O, which is Realty Income, versus BEPC, which is Brookfield Renewable Corporation, and BIPC, which is Brookfield Infrastructure Corporation. So Ed, I'm going to give you a direct answer, but I'm also going to invert this too. So the direct answer is, of these 3, I own them all. So with the Brookfields, I own the partnership, BEP and BIP, but BEPC and BIPC are economically equivalent. It's the same business. I own all three. I anticipate both of the Brookfields in total returns are going to outperform Realty Income over the next 5, 10, 20, 30 years. Of the 2 Brookfields, I expect Brookfield Renewable to be the best performer. But I reserve the right to be completely wrong and be very happy the Brookfield Infrastructure actually does better. In terms of returns from the Brookfields, I expect 10% plus annualized total returns between the dividend yields that are above 5% for both, their ability to grow the payout, 5 to 9% is kind of their target to grow the payout, and stock price appreciation. Like that's my expectation. So the inversion of this would be something along the lines of, what are the factors that could affect the performance and returns of these investments? Which of these is most likely to be a poor investment? If I were to say which of these is most likely to be a poor investment, I would say potentially Brookfield Renewable, because cost of capital could have some impact on the business. But I think that's a reasonably low chance of that. If I were to kind of reframe that a little bit and say which of these is going to be the worst performing investment, probably Realty Income, because a little bit of law of large numbers. It's a very large business. When you're buying the kind of properties that they buy, scaling up that is, you can't scale being a property buyer very effectively. So leveraging their cost of capital is really important. And they have a pretty good cost of capital because their balance sheet is so strong. It's basically an investment grade business. So that challenge to growing the business larger is a little bit of a thing that they face. You've seen one of the things that they've done is start getting into the entertainment and gaming space. Not $900 million investment to buy the Bellagio, again, not the business, the property. They bought there's a big casino here in Boston that that they've invested in. So they're moving into larger property types, right, to try to drive growth. I just think between their refinancing of their debt portfolio, because they got a ton of cheap debt that they took on over the past 15 years, they're going to have to start refinancing that at higher rates. That can put some pressure on their ability to grow cash flows, grow their dividend. They grow their dividend at a very, very small rate. Those headwinds and the ability to grow a very large business larger to get outsized returns, it's just harder to pull off versus the massive markets that Brookfield invests in, and its relative size in renewable energy and in infrastructure. So I hope that's a satisfying answer. What's next?
Yeah, that's a good rundown. Different kind of REIT too from Realty Income, I think, which is more.
Yeah, so they're publicly traded partnerships. So there's some weirdness with taxes. The good thing is that the BIPC and BEPC, those are corporations. I own the partnerships, so their dividends are a little better from tax treatment. They're qualified dividends, so most of the dividends qualified dividend, so qualifies for that lower capital gains tax rate. So if you own them in a taxable account, speaking to U.S. investors here, your mileage may vary. If you are not a U.S.-based investor, you get a little bit of an advantage of the dividend in taxable accounts versus Realty Income, which a lot of its dividend is going to be taxed at your marginal tax rate. So stuff to think about.
Yeah.
All right. What you see next you want to grab here?
Yeah, I'll take this this one on Duolingo. Ed says, what do you think of Duolingo after earnings? Worth nibbling? ? Yeah, Duolingo it's down 17% today. A little surprised by that because looks like pretty strong numbers from them.
The guidance? I haven't looked at the results. I don't follow it.
Yeah. Yeah, well, it's just give you some numbers here. Right. Revenue up 39% in the fourth quarter. Bookings up 42%. GAAP profitable, $14 million on $210 million in revenue. 25% adjusted EBITDA margin. Yeah, I don't see guidance here. I will say, this is a business that I've been kind of consistently surprised by. In some ways, this reminds me a bit of Reddit, because Duolingo is the language app. I wonder what the addressable market for this company is really, because I know they have this they've been adding higher level subscription tiers. They're up to Duolingo Max now, so they're finding new ways to monetize the business. But I haven't used it personally, but the people I know who've used it, you use. It feels like everybody knows sort of a free user for a few months. Maybe you're traveling abroad and you think it's fun. You do it for a couple months, and I think they've had some success as or they've had a lot of success as a product through this gamification of language learning. Personally, I'm skeptical that people, I think it's very hard to learn a language just through an app. You really need to speak it and use it with another live person. So the stock is, it's done very well. It's been a winner. I think for me, it's hard to get around that feeling that I don't know if the product is actually accomplishing what it's supposed to do, which is teach somebody a language. I think it's very good at engaging people and keeping them in the app, which is what it's designed to do, and what the CEO kind of has described. I think the sort of Duolingo's innovation or twist on traditional language learning is that gamification process. So I would say, I think with the kind of growth numbers we're seeing from it, I definitely wouldn't be surprised to see it keep going higher, but I do wonder what the, if we'll see a ceiling on that at some point, because as far as the product, myself personally, I don't feel totally convinced by it.
Yeah. Do you remember Rosetta Stone?
Right. Yeah. That was a stock that kind of came and went.
Yeah. So, and we saw some of the same thing. There's a period of time where growth was wonderful. The economic results were good. The profitability was good, but just kind of hit a wall, addressable market wall. And their approach was twofold. They had the retail product that you could buy on the website. They had remember the kiosks with the discs in the mall, right? They had,
Sure. Yeah.
but they also had a pretty large educational business too. But at the end of the day, it was just hit a wall. I think a private equity company ended up taking it private at some point. Just didn't really pan out. It's a very different environment today with Duolingo. You're going back 10 or 15 years ago, like the accessibility and apps and like you were saying with the way they've built the products is different. So it will be interesting to see if it is any different this time. I do want to contextualize the sell off. The stock's down sharply just over the past few weeks. But for context, we're back all the way to prices in mid-January,
Right.
So it's not like we're, the stock's come down a ton. It's just back to where it was a month ago, 6 weeks ago. So context for whatever it's worth. All right.
Yeah.
Matt asked about Cheesecake Factory. I do not follow Cheesecake Factory at all. I did eat at Cheesecake Factory 3 weekends ago, and it was delicious. So I can't give you any insight, Matt, onto the particulars of its overall operations. The locations that I've been at in Southern California, where I lived for a long time, and one close to me, are a pretty impressive level of consistency, anecdotally, for whatever that's worth. But I think there aren't very many traditional sit-down casual restaurants that have delivered great returns in recent years.
No. Yeah.
There's only a few that have done well, because you got to remember, it's the 80s and 90s when these brands really were growers, right?
Yeah.
And they've become stable, large. Now they're having to reshuffle locations, close locations. I mean, you think about like a Cheesecake Factory, that's a pretty popular mall restaurant.
Yeah.
Last I checked, the mall's not dead.
Malls aren't doing too well, right?
But they're not doing great, right? So those are factors that Cheesecake Factory has to operate through. And I think a way to think about the Cheesecake Factory is kind of like some of the other restaurants, Matt, that you've asked about over the past couple of weeks. These legacy restaurants that have been around for a couple of decades that are still around, they have to be really good operators because they're still around. Think about all of the ones that are no longer around, or that are much smaller versions of their prior self. Those are the ones that weren't good operators. If you make it, a year, 5 years, 10 years in the restaurant business, you're a good operator. So, but again, to your key, that doesn't, in an industry like that, where it can be a mediocre industry with the exception of a few outliers, largely during their growth periods, it can be a pretty mediocre way to invest. But again, I can't offer any particular insight about Cheesecake Factory beyond that.
Yeah, we were talking about this a little bit with some of the software stocks yesterday, and I know, I think actually the Chili's parent Brinker has done well lately, but yeah, I mean, I think the casual dining sector generally, what's the room, as you said, really, what's the growth opportunity there, and it really doesn't feel like there is one.
Right.
I think it's a mature market. These restaurants are very competitive. You're competing with other restaurants, and anywhere else you can eat. So I don't know what the Cheesecake Factory is going to do. That's very new at this point. That is going to make the stock, a big winner. I mean, it looks like it's a decent value and still delivering, modest comparable sales growth. But yeah, there are a lot of sectors I think that are, they're fine as businesses. But as stocks, you really need to see growth, or if
you got to find
growth,
a winner that's growing. No, that's exactly right.
Yeah. I mean, there has to be something compelling about it as a stock investment. And it's harder to see that in casual dining. And that's
Jeremy, speaking of winners, Andy Cross is with us.
Hello, gentlemen. Hi, Jeremy.
Good afternoon. How you doing?
Hey, C, how are you, buddy?
I'm fine. I have I'm just kind of catching into the markets right now after a series of other things I've been working on this morning. So it's a little eye-opening to see some of the activity in the markets. But I was paying attention to your final comments about some of the restaurant stocks and comments about and maybe it bleeds into our news or noise segment too, Jason.
Andy, I think you're absolutely right that it does. But before we do that, I would be remiss if I did not thank Jeremy for this wonderful hour and wish him a pleasurable couple of hours off to do other stuff before he comes back on later today.
Back later, but yeah, good to chat with you, Jason, as always. Yeah.
Thanks, pal. All right,
Thanks,
we'll
Jeremy.
see you soon. Andy Cross, it is so good to be back on Fool24 with you. How are you, friend?
Jason, always great. Always great to be on with you, and thank you for all your work you've been doing here to help our members.
It's good for me too. It's good for me because if I am on here answering questions and talking to smart fools, I'm not meddling with my portfolio and wreaking havoc in that way, right?
Well, in the last few days, you could wreak a lot of havoc in portfolios, and there's a lot of noise and a lot of news out there, Jason, to digest and go through, especially with investing. And so there's definitely a lot to talk about.
There is. So news or noise, this is something, I was on vacation last week, so we didn't do it last week, but we're going to try to make this a weekly feature on Fridays. Andy will join me when he can. We'll have other fools that'll join me when Andy's not around. So again, the idea with this, for those that didn't see the first episode that we did, is to take your questions and to look back in the news and the market and the things that are going on, and to try to figure out is it news? Is it actionable? Is it material? Is it signal, right? Something that's useful, that tells you something, or is it just noise that, okay, now we know it, time to move on, right, Andy?
And not just that, Jason, but there's also, if it's news and it's some signal, is it the right signal?
Yeah.
So that's very important. So a company like PubMatic, which is down more than 20% today after their quarterly earnings. Again, I have not gone through the whole earnings, and I'm not sure if we talked about it on the show. Just again, because I hadn't chimed in as much today. But from what I gather, when looking through the news this morning, the underlying health of the business was actually fairly strong, but they have a continued struggle with one demand side platform. They're a supply side platform, and this is the demand side platform, and they've never disclosed who that is, but it's a big one. So it's the likes of the Trade Desk or Google, maybe Verizon, and just the challenges and the changing patterns of that one DSP, and that's impacting PubMatic's financials and will for the next quarter or so. But that lapse through that 1 year cycle they've been talking about lapse at the end of Q2. So they have 2 more quarters of this. And I think their other underlying business, if you back out maybe some of the political business, especially in CTV, connected TV, again, this is PubMatic, PUBM, was actually quite strong, Jason. And this is a business that manages their balance sheet, manages their income statement, their cost structure very well. So I see a stock down more than 20%. It's obviously driven by the news, Jason. Mm-hmm. But I do wonder if that signal with the stock dropping isn't more of like this, now it's down to, sub $12 per share. And I think we were buying it maybe in the $14 range. So that starts to get even a little bit interesting to the value side of me if some of this news is more short-term in nature.
Yeah, I think that's a good example, and we can tie that to the Trade Desk, which is one of the large companies in ad tech that's on the other side of the ad market, working directly with some of the biggest ad buyers in the world, going back to their results and looking at the big drop. And what you have to remember, like you said, is that there's news behind those drops, and it's the why, the signal, and trying to identify if there's something in that signal that's informing whether or not you should act on it, or it's time to just continue watching, right? What's going on. So I think in the case of the trade desk, because I know that's one that you've looked at and that I've looked at, I can say that the stock price dropping wasn't just noise when it reported. Results were good, but the guidance was far from what was expected. And when your founder, who's the CEO, and Jeff Green, somebody that I think I can speak for you and say that we have deep admiration for as a leader that we trust, that knows his business, that knows his market, that knows his customers, and has kind of driven the future of programmatic advertising, says we didn't do well. We had some operational mistakes, and here's how we're going to fix it, and laid out this very detailed list of things that the trade desk has to do right and do better. That's as signally as it gets, that we as investors need to let the trade desk show that they're addressing the concerns, not just, okay, back up the truck, guys. The market's freaking out. Everything's fine. Jeff Green told us, hey, we got some stuff we got to work on, right?
Yes, Jason. Sorry, I'm going to do Natasha. I'll do a quick screen share here, if that's okay. If I can find the actual screen share I want to do. Actually, you know what? I'll do that in a second, Natasha. But yes, Jason, I was thinking about this as we did our special show in the trade desk, operational challenges, especially with Kokai, as they've probably not done that they have not rolled that out as exceptionally as well as they have. There was also historical context. They were exceptional performers when it comes to delivering on their expectations and exceeding those. And this was the first time in years they had not done that. It is, I do, as Jeff Green on the conference call, I think as direct up front, and I can imagine behind the scenes, it was much more tumultuous with his team. Yeah. But showing more grace in the public fashion as a leader should be. But that was as direct as you will see, I think, from a CEO saying, we did not get this right, and we have some operational challenges we have to get through. I think the underlying concern with investors were that operational mistake is one thing, but if the market is dynamic, is shifting, if their competitive position is weakening, either because demand side is not as valuable as it once was, if their clients, there's a lot of ad clients, advertising agencies on their client side, if they are not spending as much and there's not as much inventory going through them, or not supply going through them, or demand, going through them. So those are the separation between the news and the noise. So I think that was, there was no doubt that it was warranted for a, hey, listen, from an investing side, stock side, that's going to sell off. The degrees of it seemed a little bit aggressive to that matter, as it does a little bit, I think, with the PubMatic, which, the stock is down more than 40% year to date now. Not year to date, over the past year for PubMatic.
Yeah. And so the interesting thing too is I think it's one of those situations where, thinking about signal or noise, you think about PubMatic, you think about the trade desk. Oh, these are ad tech businesses. Ad tech's going to continue to grow. The tailwinds are behind it. And that noise can cause you to miss the signal that these are, sure, they're in the same industry, but they have very different dynamics. And operating on the supply side, dealing with the inventory of ads, which is where PubMatic lives, versus working directly with the marketers and making money with your platform to help inform them how they market, where they market to get the best return. The dynamics are exceptionally different. So I think that's really important, is you can't just throw everything in one pot, stir it up and call it soup. You have to understand what the ingredients are and what their role is.
100%. You absolutely do. And this is why we love investing and love studying businesses and digging into different generative AI tools and whatever research tools going through the conference calls. And Natasha, I have a screen share there of one page from PubMatic's conference call or presentation, Jason, that I just wanted to point out, which is this part right down here. I don't know if you can see that. Sorry, it's maybe not too big. It says the value of the digital advertising supply chain is shifting to the supply side, where PubMatic is a clear leader. That was one takeaway from this deck that I was, as I'm going through it, and I'm saying, I think for so many years, the demand side was really where the value was created, and that was the big driver behind the trade desk success. And just wondering, is that balance now starting to lean more toward the supply side than the demand side? I don't know for sure, and certainly not and we still have conviction in the trade desk, but just thinking about the competitive dynamics in a marketplace where DSP, demand side platform, SSP, supply side platform. So the inventory, the publishers who are looking to sit, and that side looking to sell inventory, and those who are looking to buy inventory. The situation, the great success that AppLovin had seen over the past year or so, Jason doing very successful in mobile gaming and mobile advertising, building that platform. How does the balance work between those? And there's a lot of frenemies too. So, I mean, Google is both an SSP, also a DSP. The trade desk is kind of pushing a little bit more towards supply side optimization as that business is also evolving for them. So there's a lot of frenemies in here. Yeah. But this is why investing is in businesses, why investing is not risk free. And that there's uncertainty, and we pay a premium, or we should pay a premium for the riskiness of that investment, but also ideally for the expected returns of that investment too.
Well, it's interesting, that particular thing that you brought up with PubMatic is, I think it's so important, because one of the reasons that I had moved away from the supply side and exited my investment in PubMatic well over a year ago and avoided some of the other smaller players is because that space has been so crowded.
Yeah.
And we've seen lots of companies shift places in the pecking order with market share, but nobody emerged really dominant beyond the walled gardens, the alphabets with Google and YouTube and the social media platforms. Yeah, Meta, right, exactly.
Yeah, Snap.
But in terms of like a pure play supply side, like a PubMatic and its peers, it's been so crowded, and we're starting to see it is starting to distill down a little bit, like you said, with PubMatic, and it has certainly become a lot more interesting to me, because I know they also have just some operational things that they've built in that should give them leverage as they grow and scale and take market share to be more profitable. So I'm interested to see how that plays out. So it's crept back on my list.
And I think you're right. And then in fact, I was just talking about this morning in a couple of different videos and interviews I was doing, is trying to identify the uniqueness, the unique advantage to any asset that a company manages and runs and has and owns. That's where so much of my focus is as an analyst. And so PubMatic has some of those in controlling their own technology stack, their own cloud infrastructure that others don't have. That's always been an advantage, founder-led, very focused on profitability and cash flow from the very beginning. That showed up again this quarter as well. Those are, I think, advantages they've had. But when there are headwinds blowing against you, or against a company that is for different reasons blowing against you, those advantages are in the near term are much harder for investors to truly value. Past those headwinds is where those assets really start to value, Jason. And so PubMatic, I still think, has many of those assets, but right now, clearly, with that DSP challenge that they're facing, and maybe some others. Again, I have to pick through more of the call. That's reflecting in the stock price. So that is all news. It's the degree, Jason. 20%, 30%, 5%, 10%. It's always the degrees that is a little bit more of the noise for me.
Yeah, no, that you're right. It's not binary, and we talked about that in the first episode where we want to take like a 1 to 10 is 10 being this is clear signal, useful, actionable. 1 being, man, this is just really noisy and not particularly useful, right? And figure out where on that gradient it lies.
And Jason, your restaurant example with Jeremy is, so when you see some of the macro data coming out, restaurant ordering or whatever it might be, from different industry studies, I always see that as it's not completely noise. I'm not putting that in the 1 factor because that is interesting to pay attention to, but there's so many different interplays in between the different restaurant companies and who might be benefiting, who might not be. Is it fast casual? Is it takeout? Is it this? Is it that? Different. What's impacting the Wingstop? Wingstop is much different than what's impacting, a company like Texas Roadhouse. Right. So I think from that perspective on the restaurant side, and you can take it to other different industries. I always see those as like, well, they're interesting, but that the selling in the stock at any given day I see as more. It might be driven by some of the news, but the signal is really noise.
Yeah. No, I think that's exactly right. Well, again, it gets back to the Ben Graham voting machine weighing machine when it comes to the market. Over the long term, the tail of the stock up or down is going to be tied to its ability to grow its earnings per share. So that's what we have to remember.
The housing numbers were terrible today, weren't they? Wasn't there?
It's not good.
Right. So right. So that is, there's definitely news there. And, there's some indications there, but how much, to what degree, and how much is real signal, I think is always the challenge we have as investors.
Yeah, no, that's exactly right. So here's one, we got a question, and okay, here it is from Ed. Arista Networks, ticker ANET, has been a great performer. Going forward, do you see any headwinds? Will it beat the market? I will say, and I think this just published over on Fool.com, or not Fool.com, excuse me. This is something for members. The Bottom Line, the earnings show that we do where we take a look at popular stocks in the Fooliverse, often ones that are recommended in lots of service. And yeah, this published today at 2:00. So I encourage fools to go over to your premium ticker page for Arista Networks. And I'm sharing on the screen right here. See those handsome devils? Got me and Toby and Lou. We featured
which one is the handsome devil?
Oh, the one in the middle.
Oh, got it. Yes.
Yeah, not Lou. Certainly not me. So I'm kidding. Lou and I, we have a it's completely fake. We have a fake rivalry that we only do for a show. But Arista Networks was our spotlight stock, and the short version was, I think if you look over in the near term, there's this kind of donut hole of uncertainty that we don't know over the next 2 or 3 years, when half your customers are the hyperscalers. Half your revenue comes from the hyperscalers. We don't know 2 or 3 years from now, this accelerated AI investment, accelerated computing spend is going to continue. But I think you look out 10 years from now, and I think I can say with a certain amount of confidence that I think Arista is built to continue to be the winner.
I think that's right. I own the stock. And so in my parlance, this is not always the case in every position, but you own a stock, you think it's going to perform, whether you're buying it today or you own it, you think it's going to be capital that's invested to deliver some kind of return. Or else why own it, right? So in my case, I own stocks because I think they generally, in some cases not always, but with Arista, yes, generally going to beat the market. And I think the market is probably going to earn somewhere between, it's been pulling back more recently, but call it 7 to 8%, Jason, maybe over the next 5 years, right? It's been doing 15 to 17% for the last 5 years. It's not going to do that over the next 5 years.
I'm glad you said that. History tells us that at some point when we go on these incredible runs, they're inevitably followed by a period of below average returns. It just happens.
I mean, it's just there's some math there, and it's just historical reality. Right. So call it that, right? Which, by the way,
that's still better than bonds.
Inflation, that's still it can be very good. That still can be very good. Index funds, of which I own, right? So I think Arista can do better than that. I think it probably can do better than 10%. But the volatility of the market is going to be, I don't know, 15 to 20 standard. What's the term I'm looking for, Jason?
Beta.
Yeah. Yes. So the beta of the market essentially going to be 1, and without looking at Arista's beta, it's probably going to be 1.5, call it maybe like that. Yeah. So relative to the volatility of the market, Arista is will be far more for the reasons you just mentioned.
Yeah.
From the singular risk profile, we don't necessarily know at what point the data center momentum, and then I see a question from, I think it was from Melissa about Imcore. Imcore also is tied into the data center build out, and some of the softness has been tied to that as well too. The expectations probably got a little bit too enthusiastic for Imcore, and now that's pulling back. I own Imcore as well too, and I still think that's going to be the market going forward. But both of those businesses, Imcore and Arista, have this data center tie-in, and the marginal improvement in the business, if not also the stock price, probably even more so, the stock price has been tied to that. As that layer starts to fizzle, people get less traders get less enthusiastic, and maybe Nvidia is not going to grow as much as it used to be. All of those reasons, the market's going to sell those off. If they're selling off one way or the other in any given day, a stock price, any given day, and is being driven by second or third derivative factors, either a macro factor or a client competitor issued, a cautious area concern, those kinds of things, those just start to move further and further down the noise, towards the noise spectrum.
Right.
Not that it's not news, but it's less tied to what the company is directly saying. And then you start getting more into the inference. I'm inferring, I'm trying to make the second level decisions, which is what we try to do as analysts.
As something to affect your decision.
Yeah. And as our job as analysts, as you and I talked about, I think in the first show, is we're always thinking about those second, third, fourth level decisions.
Right.
Those removed decisions and how they're impacting, our businesses. But they do start to get a little bit more into guesswork. And you're assuming things, and that by nature gets into be a little bit more noisy.
Yeah, no, I think that's exactly right. And I think the noise when it comes to Arista Networks, before we talk about Imcore, because I do want to have a little bit of a deeper conversation about what's going on with Imcore. I took a really deep look at their results. Tyler Crow and I, fellow Fool, have talked a lot about Imcore and really dug in. But thinking about with Arista Networks, thinking about the noise, there is a lot of noise and hype around AI that has certainly driven its stock. But I think broadly, we are in the age of accelerated computing, Andy, whether it's artificial intelligence, which the implications I think are enormous for the economy broadly, for how we work, how we interact with every bit of technology, cars, machinery in factories, industrial, like all of those things are going to be touched by AI that are going to unlock some level of additional performance, productivity, safety, so many positive things at some point down the road. It's really noisy right now because like seeing the material results of those things are starting to fits and starts come in, but it's still so many years away for a lot of the biggest implications. But thinking about a business like Arista was, Andy, I'm not even going to try to say his first name.
Bechtolsheim?
Bechtolsheim.
Yeah, Bechtolsheim.
This is a genius. Still their chief architect officer, one of their founders, but he and their other founders had a clear vision and were not blinded by their success early enough in this business's existence to realize that they needed a CEO, that they needed somebody who knew how to run a business. And they got one of the best in the world, I believe. She has led the business through their IPO, through a massive amount of success. kept the business operationally focused. But the key is that this business was built for where computing is today. Accelerated computing, high-speed data, being able to connect nodes in very, very remote places, focusing on security, just an exceptionally built company that continues to innovate and stay ahead of its competitors. And just past, I do this on Fool24. I forget company names. It's Cisco, right? Past Cisco in market share this quarter. That says a lot about how quickly this company has become dominant. So the signal to me is very, very loud and clear that this is the leader and is built to remain the leader, no matter what happens in the near term. All right, you want to talk about Imcore?
Well, sure. I mean, I think, yeah, I value what you all, you and Tyler had dug up around Imcore. I think the story there is they had an exceptional 18 months.
Yeah. Yeah. Mm-hmm.
And that exceptional 18 months is not going to happen again in 2025.
Right.
And, I think playing it forward and that will just always continue. And even if investors weren't expecting it to be continued that much, it's just that the level of how much that would continue and the difference between a few months ago and now in the short term is big enough to drive the stock down 15, 20%.
Yeah, right. I think that the key to me is that is the reality of a business like Imcore that is a cyclical business, and it's going to go through those periods where they can't keep up with the demand. It's so much demand. They can't keep up with it, and there's going to be cooling off periods. And that's the reality. And for investors that don't understand cyclicality for companies like Imcore, where you're basically a professional services provider, electricians and HVAC contracting, it's easy to get caught up in the noise and think, well, I missed this and it's time to get off, right? I got to get off the ride. I'm not just going to go in circles here. And remember that the secular opportunity is still pretty darn big, Andy.
Yeah.
If you think about, go ahead.
No, finish your point. Please keep going.
So it's certainly been tied up with everything with AI and the build out of data centers, and the math around data centers is great for a company like Imcore because something like half of the money that gets spent on a data center is electrical and HVAC.
Yeah,
that's what they do, right? So a data center gets built, more money goes to Imcore or Quanta. Is it Quanta?
Quanta Services.
Quanta Services is two of the biggest. They get a bigger share than NVIDIA does, right? It's just it's a very, very big spend. And then there's maintenance and services and things that follow over the long term that they get as well. But we've been so focused on that, we've forgotten about some of the other things that are happening at the same time with nearshoring, energy transition, electrification of everything, the demographic trends where there's a lot of growth in the Sun Belt, where there's economic opportunity for this business, and they've acted on that. They made an acquisition. It was announced right around the same time as the DeepSeek news came out that's tanked a lot of the AI stocks, where they spent around $850 million to buy a company that gives them a lot more boots on the ground in the Southeast, particularly Florida, where the demographics are incredibly positive for a business like Imcore. In terms of economic growth, it's going to really drive their ability to get through these periods. But the last thing I wanted to say is that, sure, while the build out may slow down, this is a big services organization too, where it's not just buildings getting built that drives their business. It's maintenance and upgrades and improvements too.
Yeah, 100%. So it's think about it almost like the Apple ecosystem. You buy an iPhone, you join the more people get iPhones, the more opportunity to have the services. Similar with Imcore, not exactly, obviously, but they provide the services and they have that maintenance, ongoing. But last year, Jason, was for Imcore, when you just look at their sales numbers, You're thinking about a business that was growing north of 15% a year. The year before that, it was north of about 14%. And this year, it's probably, I think it's probably going to be somewhere between the 10 and 11 or 12% level.
Yeah.
Their, their operating income last year grew, I think, almost 50% or around 50%. Their average, if you go back, history for Imcore, this is, this is like a, high single digit kind of revenue growth business. By the way, their RPO, their remaining performance obligation going into this year, I think is still very healthy, above 10%. But this is not a business that grows at 15%, probably 15 to 20% per year going forward without acquisitions, just, without a big acquisition, right? It's probably more of like a high single digits business. And I think, for me, I bought a small position, a starter position, kind of get to know it. I was impressed with the ability to turn that revenue into profits, looking at their pipeline, looking at some of the opportunities that you had mentioned across the different geographic location, but then also just the continued build out of both data centers as well as more efficient buildings that we need, and hospitals and schools and all of those things that we need.
Semiconductor manufacturing plants,
all the industrial
LNG,
manufacturing,
facility.
Especially onshoring, as more and more that business comes back to the onshoring, really focus U.S. business, all those things. Probably just paid too high of a price for it. Really kind of, that's a little bit of the story. Like, these businesses, as you mentioned, they have these different cycles to it, and probably just paid, at least in the near term, a little bit too high of a price. But again, I'm thinking about this business. It's going to be a 7 to 9% kind of grower. I think they continue to get margin improvement. They historically have been very adept at that. And you look at the valuation today and you say, I think that from a risk-adjusted ability to beat the market going forward, to me, as that stock price has fallen over the last few weeks, that gets more and more attractive from the risk-adjusted basis. Is it tied to data centers? Will it be priced in the noise section to some data center data that we see or other earnings from companies that come out? Undoubtedly. Absolutely it will be. Because that is a part of their business that everyone is focused on.
Right.
And has been for the past 18 months. But it's not the only part of their business.
And it's the kind of noise that can create opportunity, right? And we as investors have to learn to tell the difference, because one of the things that I've learned, Andy, because of the painful price of learning it, is every time a stock dips is not an opportunity. A lot of times stocks fall for a good reason that's bad, right? There's a problem. So learning how to differentiate those is really, really important. And the way you do that is know the business, know the industry, know the puts and takes, and act based on the quality of the business, not just because the stock price fell.
That's right. Absolutely, Jason. And that's why I said with the trade desk, when the trade desk fell, I said, I'm not buying like right now. And when I say right now, I mean like as of like today, when it fell, I really wasn't, because I just wanted to see it kind of play out. I wanted to see how the short-term momentum traders reacted to it. That's just my principles. I very rarely, when a stock is falling dramatically on a day or 2 days, will go in there and chase it. I'll just kind of let it play out a little bit in the marketplace. But Imcore now, you have a stock that's selling at $400 a share, which I know sounds expensive from a nominal basis. It is, but on a relative basis, it's selling cheaper than the market multiple. I'm not saying this year it's going to be a gangbuster stock, again, coming off of a really good past 18 months. But I do think from these levels, with its ability to turn revenues into profits and generate higher revenues and grow from a $17, $18, $19 billion business to one that's probably more in the mid-20s over the next few years, I think that's become a higher likelihood as the stock has gotten a little bit more reasonable. And Jason, you mentioned, again, you see this with cyclicals time and time again. We've certainly seen it with the likes of NVIDIA and others. We might be seeing it with a lot of the housing companies now. The housing stocks are companies that are tied to housing stocks as well too right now.
So I want to to wrap this up, there's a couple of things that I want to hit on that I think are the things that set up a business like Imcore to be a high quality investment, that I think that there's a very good probability that it can beat the market over the long term. Andy, I think even your earlier buy that you said, rightfully so, probably was a little bit expensive. I think even that investment's going to work out really well over the long term. And I'm going to start with, I mentioned the acquisition that they just made. Miller Electric, I believe, is the company that they bought. You look at the terms that they announced of that deal. I think they paid $865 million. Miller Electric's trailing 12-month revenue is a little over $800 million, with like 18 or 19% EBITDA margins, which are, you got to be careful using any metric that like EBITDA. But they bought a business that was already profitable. They paid what looks like a pretty reasonable price for it. They're going to bring that in, and they're going to all the back end, like the back room and back end things that they can drive cost out and improvements that they can make. They've proven historically they are an acquisitive company, largely small bolt-on acquisitions, taking market share and expanding. They've been really, really good at that. The companies that are really, really good at that in spaces like where Imcore operates, which there are lots of small players and there's room for consolidation. You find the ones that can do that really well. That's almost always a good signal of a good business that understands how to capital allocate and how to expand well. And then I'm going to share on the screen here, folks behind the glass, if you can release this. This is operating cash flow since Imcore's IPO, trailing 12-month operating cash flow. There has been one 12-month period in the company's history where it did not generate positive operating cash flow. That says a lot about how this kind of business is structured. Yes, the end markets are cyclical. We can see the ups and downs, right? So coming through this is the financial crisis that we saw a little bit of a dip there. This was the pandemic. We saw a little bit of a dip there. It's a business that's built to last and to generate cash across these environments. When you find businesses that are good at allocating capital and they can generate cash across environments, Andy, generally those are two really good starting points for businesses that can do really, really well as investments. You bolt that onto the tailwinds of the in-market opportunities, and I like the potential for Imcore to be a really good investment from here.
Yeah, Jason, I think that's right, and I think it's it's one of those ones that's obviously going to go with the spend of their clients, and that's on the building side of all those things that we had mentioned, and that will ebb and flow over the next 3 to 4 years. But Imcore it's not a service that vanishes. Same thing with like the likes of Top Build. I mean, we need our insulation. Right. It just doesn't it doesn't vanish, and you have a lot of scale in those businesses. Same with the distributors and the industrial distributors. But those businesses, they just sometimes when building slows down, those stocks, and not surprisingly, will get hit. But those tend to go in a little bit of cycles. And I think especially as we're thinking out over the next 3, 4, 5 years, we're just going to see more and more of those, whether it's data centers or other building. Not right now because of not only right now, just because of some of the environment and some of the commercial spending side on the buildings tied to CRE, but I think we will see more and more going forward, and that's going to be good for Imcore.
I'm interested, Andy, to see how as AI gets better and we start to see monetization of AI for these blue collar industrial businesses, the use cases for AI to help them become better at what they do, more efficient. I'm really curious to see how that's going to work out. Scheduling, for example, if you've got your service technicians, routing them in the most efficient way. You have an emergency call coming in, rebuilding their route to make sure that they're most efficient, providing the best service, and also using the least amount of fuel and maximizing their hours and all of those things. I'm really curious to see what happens with some of those applications. So,
Jason, you must have been sitting in my house when I was doing some of these interviews today, because when we were talking about AI, I said the thing I'm most excited about is how it changes and impacts in a positive way. Companies outside of technology.
100%. Yeah,
I think it's just going to be really, because we're seeing it every day in our lives. We're seeing it at the Motley Fool. So it's not so much about the NVIDIAs of the world, but it really is much more about, to me, it's about the MCores of the world and how we get more and more efficient using the different technologies, as it has been, across 50 years of technology or 100 years.
Absolutely agree. Yeah. So Matt shared this from an earlier conversation. We were talking again, bringing back around to restaurants. The Cheesecake Factory, Simon, the mall operator, calls it one of its exceptional brands. Well, Simon is a mall operator. They want to highlight things that give good customer experiences to people that come to their malls. And that's part of it. So that's a little bit of my cynical answer. But brand value is something that Cheesecake Factory has consistently done a good job of leveraging. And all of these traditional sit-down casual restaurants that have survived and thrived, over the past 15 years, as they've been faced with the challenges of the Chipotles and now Cava and these other fast casual restaurants that have taken a massive amount of the market share. Those are the ones that have the brands and they deliver on the promise of that brand. Mm-hmm. And in Cheesecake Factories, it's a 1,500 calorie slice of deliciousness. I love their cheesecake. It's so good.
It is so good. You know what I ordered from Safeway was the bread rolls. And I brought those home, and my girls were like, "Whoa, you went to the Cheesecake Factory?" And I said, "Well, no, just at the end of the aisle of the Safeway, packed, lots of calories and preservatives probably, but they are so good."
Fantastic. That is fantastic. All right, you see a question in the queue you want to grab, Andy?
Just very quickly, a couple from Jimbo that I'll try to get to. Arista, or some of the Motley Fool reservations of buying Arista today related to valuation or the risk of big spenders ending or reducing their spends? I think it's both. The valuation has gotten much more attractive. Certainly, at one point, it was north of 20 times sales, and I think north of 22 times sales. Mm-hmm. Keep in mind, Arista is very profitable, so for the earnings multiple was far more reasonable. And these are legitimate, real GAAP-based earnings, and we're talking about Arista, ANET. So I think a lot of it is around the valuation, but just when there's so much money and so much excited enthusiasm tied to a part of the market that a company depends on, I think our natural tendency is like, okay, let's just be cautious and make sure that money goes in and could easily come back out. Yeah, and so how much is that? They're very concentrated into Meta and Microsoft spend, or key clients of theirs, much like NVIDIA has their key clients, Arista has key clients. So I think, Jimbo, that's just some of the, just thinking through, like, it becomes a real a timeline and allocation question, Jason. How much capital does somebody have allocated to Arista? Are they interested in building out a position more? Those questions are the big driver of whether the enthusiasm around buying Arista today. Again, I own it, so I believe it will beat the market over time. But it's also not a top place of new money for me personally adding to my Arista position right now.
Yeah, I think that's exactly right. And I've alluded to it before, but I'm going to directly say it. I feel far more confident projecting Arista Networks being a very satisfying investment result in a decade versus 3 years from now, because we're in this period where it's a little more challenging to say what's going to happen. I want to hit on that profitability that you were talking about, like the cash generation. So here's just a number that jumped out at me. Generated $3.7 billion in operating cash flow last quarter, Andy, on $7 billion in revenue.
I mean,
it's incredible.
You pointed to all of the greatness that Arista, leadership, position in the market, taking share from Cisco and all of the rest. But they're very much like PubMatic. Their focus on profitability from the very beginning, almost the very beginning, has always been something that's really been impressive.
I have a. Go ahead, Andy. I see you.
I was going to pivot to a different question, but if you want to,
no. I have a question for you, but I want your question first.
I was going to go with Jimbo's question on the CNN Fear and Greed Index.
Yeah.
This is something I just actually wrote on recently. both with the fear. So Jimbo has a question. How does the PGI relate to the CNN fear and greed index or the like? How do you characterize the current market sentiment? Jason, I want your opinions as well too. So we have our PGI, which is our potential growth indicator. It's a measurement that Tom and his father created, measurement of cash essentially on the sidelines compared to the overall measurement of public market equities. And the idea being that when that ratio starts to increase, when cash increases, stock values are falling, there's more and more fear in the markets. Markets are becoming more interested in holding on to cash than they are putting it into stocks. And when it goes the other way,
if you could release a screen share, I'm actually going to pull up the PGI on the screen, Andy, while you're talking. Go
okay,
ahead.
great. And then I have the fear and greed, and we can share that then next too. Is when it goes the opposite direction, that means there's more money going into the markets, less money on the sidelines. That's the essential with the PGI. You see it right now at about 11.4, 11.43 if you carry it out. I think historically it's ranged somewhere between 9.5 and like 11.5, kind of. So essentially 10%, Jason, call it 10%. Mm-hmm. It's peaked at around 40, 45 during the really tumultuous part of the great financial crisis. And I think it's the lowest I think I've ever really seen it get to is somewhere like in the 8 range, 7 or 8 range, somewhere around there. Maybe even less than that, maybe 6 or so during the boom times of the internet mania in the late 90s. So greed and fear, the CNN Greed and Fear Index operates in a similar fashion. The American Association of Individual Investors Index, AAII, which is a sentiment survey, operates in the similar way. They're basically trying to gauge the sentiment of the American investor and the American consumer. And Natasha, I will share the Greed and Fear Index, and then we can move on to a different one. They basically work in the same way, Jason. They're basically trying to gauge the sentiment of the investor today. Are they more or less interested in investing? The Greed and Fear Index, you can see right now that scores at extreme fear. The Association of American Investors, the AAII sentiment survey, also is, I think, at maybe 2-year lows. So a lot of uncertainty and fear in the market. Here's the thing, Jason. I see these as reverse indicators. When there's a lot of fear in the markets, whether it's from the AAII or from the CNN Greed and Fear Index, or even from the PGI, when that PGI number moves higher, because again, the higher it is, the more cautious investors are, that's when I start to get more excited to be an investor.
Inverse correlation.
The inverse, thank you. I said reverse inverse. The inverse correlation. When those numbers, when there's a lot of fear in the market or uncertainty in the market or lack of interest, and I think we can all feel it now for all of the reasons we've been talking about recently, from the macro all the way down to the micro, there's just trying to understand, gosh, should I really have money in markets right now? Should I be more cautious on pulling back some of my holdings? For a long-term investor perspective, by the way, the CNN is a little bit more of a short-term mentality, trading mentality factors here, as you can see, put and call options, stock price breadth, relative strength, a little bit more of those shorter-term factors. That's where, as a long-term investor, I start to say, whoa, if the market is getting cold feet, if they are much more interested in selling, I should be maybe much more interested in buying.
Well, I want to talk about that for a second, because I think this is where we have to be careful about thinking about using these signals as being actionable or not. I think one thing that we do know is that over the long term, you're exactly right. There is an inverse correlation. When the market is most fearful, that's usually when there's the most opportunity to be deploying capital. I think we should also be mindful of the fact that that doesn't mean that when the market is the most greedy, that we should be exiting. Ben Carlson is wonderful. I recommend folks sign up for his A Wealth of Common Sense newsletter. He's a great thought leader. He's an expert. If you like Morgan Housel, you'll like Ben. I think it's the best thing that I can say, maybe the biggest compliment that I could give him. But he works for a big money manager, Ritholtz Capital. And he wrote just this week about, that he's worked with thousands with a T of wealthy people. And not a single one of them has ever described building their wealth based on timing the market.
Yeah.
Right. So that's the big thing. The thing that is going to reward you the most as a stock owner is just getting out of the way and let the managers of these businesses that buy the wonderful businesses, let the wonderful managers of those businesses do the hard work. And we just kind of sit around and collect the results over the long term, right? Holding through these periods, having the capacity when there is lots of fear, not trying to get it perfect in time and exit, and then deal with the implication of taxes and all that stuff. And then that's like, you have to get your returns 15% higher now just to cover your taxes because you realized a gain. So don't even mess with that. Hold through that period. But if you are a net contributor and you're looking to deploy capital, maybe it is going to create opportunities to buy, but holding is really how you make your gains, not trying to sell the tops.
Yeah, and Jason, maybe we can hammer through in the last 8 minutes you have with me, hammer through some of our questions here. But for me, Jason, and I think Tom's talked about this, it's not so much the that we're not buying or not selling. It's much more about the kinds of companies as the markets are going through these different valuation periods. And so John mentions about Brookfield. I mean, Brookfield is a wonderful example, Jason, the kind of business that you have very talented management teams that are investing in very unique assets out there in very strong ways, and let that team do the work for you over time. And it has been a fantastic performer for that reason, very much like Berkshire Hathaway, with a different style and approach, but somewhat similar. And so in this kind of market, as I recently, when I did some rankings, it's just like, I might be more interested in companies like that than I am in companies like, as much as I love the likes of a CrowdStrike or a Trade Desk or ServiceNow, it's maybe less of that kind of business, is much more like an Imcore or a Brookfield or something like that, where I'm thinking about allocating capital. So it's the types of investments that I use these indexes, these sentiment indicators or the market indicators like the PGI that help guide me in the kinds of companies to be buying or selling.
Yeah, exactly. I mean, the idea with all of these pieces of data is they're just that. They're a data point. They're something that we can use to build on to help reach our decisions. So let me do this first. I'm going to grab. So John Gage was talking about Brookfield. He pointed out something really important, and I want to talk about this about Brookfield Corporation, Brookfield Asset Management. If you look at their presentations and they're laying out their guidance for returns, if you're a U.S. investor, make sure you know whether they're talking about Canadian dollars or U.S. dollars, because I teased John a little bit. He was talking about with Brookfield their guidance for, I think, $176 stock price by 2030, which looks incredible from the price of the stock trading on the New York Stock Exchange today. Yeah. But that's the Canadian stock that trades for about 60%, 70% premium to the U.S. New York Stock Exchange stock. Yeah. So. But either way, it's still a really, really good return. So just, signal. Yeah. It's important.
And Milner Time says about App 11 or Axon. Jason, gosh, that Axon quarter was stellar. The week before, the stock had sold off 15 or 20% on the Flock news, a partnership. Mm-hmm. So I'm not saying that was noise, and hindsight 2020, but like that wasn't really even. I thought they had reported earnings early when I saw that news. And that was just an indicator of like, hey, we're changing, our partnership has kind of worked its way through, but there were the second, third derivative factors that traders or investors were thinking through, like, oh my gosh, this is really going to hurt Axon's business. I'm not saying that it's not going to be impactful in some way, but then Axon followed it up with a quarter that was absolutely outstanding. And just the further of just saying, hey, that one piece of news turned out ultimately, at least right now, to be a little bit more noise, because the real news showed up in the earnings when they had reported that outstanding quarter, and continued very healthy guidance for the year because of the types of tools and services they are providing their clients.
I can't remember who said this first, but I think actually it might have been Tyler Crow about Axon, that it almost feels like there's got to be something funny business going on because the results every quarter are so good and they're so close to what management says. And like he said that as a compliment. And like, I don't think there's any funny business going on there at all, but it's uncanny how well they know their business, they know their customers, and how well they're leveraging the opportunities to continue expanding that business.
Boy, Jason, we talked about the ecosystem with Imcore, and then I mentioned with Apple, and that's been the biggest evolution and success for Axon over the last 5 to 10 years.
Yeah.
Is the building out of their cloud infrastructure, the cloud services business, their services business tied to the TASER and the hardware side, and having the evidence monitoring one. Now they're doing it with drones, doing it with cameras. They did it with TASERs, cameras. That's been, and that gives them the ability to be able to have more healthy forecast into their future performance, which has allowed them to be able to manage the business a lot more effectively than what they could do 10 or 15 years ago, when really it was just the TASER business, the one-off, not just one-off, but it was much more just on the hardware side.
Right.
They've been really successful and that's been impactful up and down the entire the entire value chain of trade desks, that has led them to be able to deliver those kinds of financial returns, which has driven the stock.
Milner Time's asking about AppLovin too. You had a chance to dig in? I mean,
just
AppLovin.
An unbelievable. Here's the thing with AppLovin that I think that they are really building from a specialty perspective. As more and more capital dollars go into mobile advertising and mobile platforms, that they're playing this really central role between developers and ad clients and users. They're playing this central role that has a real advantage that I didn't really fully appreciate a year ago when I looked at it. And that is showing up now in their financials. Here's the challenge with AppLovin: is the stock just went ballistic. The stock went ballistic, and I think it just got way over its skis, and now it's pulled back from that price. But they, I think from an asset perspective, they have something really strong going. I think the valuation just got a little bit too excessive for AppLovin.
Well, looking at it objectively, just looking at the trajectory of the stock price and their cash flows and revenue growth, they're delivering on the unit economics of the business that a lot of these sorts of platform businesses can. We're seeing that happen at scale, right?
Yeah, exactly. And I just think as more and more dollars go into mobile development, game development, and mobile advertising, that they're sitting in a sweet spot, which is very much like what we started to see with like the Trade Desk and Roku on connected televisions. Just now you're seeing it on the mobile side. There's Unity as well in there too, and Unity is much more of a turnaround, trying to kind of work through some of the challenges they have with their developer network, their pricing, and new leadership team.
They really damaged their own reputation with some decisions they made with pricing.
Yeah, they did, and that was the old management team, and now we have the new one, and the stock's up more than 50% over the last few months. So that's been a nice rebounding story. So you're seeing a lot of enthusiasm around the gaming, mobile gaming, and that ecosystem, dollars going in there, ad client, the advertising opportunities. We're still seeing Roblox evolve their advertising platform. We'll have to see how that kind of plays out. I'm excited to see that. And AppLovin benefited from that over the last year, but the stock just got, it was real, like there was just a lot of especially individual investor momentum that piled into that stock.
All right, let's shift here a little bit. We're out of time. How'd that happen? We're out of time.
I mean, we could. It just seems like days would pass, Jason, if we were on. In fact, we have been on for days, I think, at various points in our life. Together.
Yes, ladies and gentlemen, imagine Andy Cross with a beard and somebody saying, "You guys look like twins." We were there at one point.
Not that handsome, Jason.
Yeah, let's go the other way with that, buddy.
But you are getting. Yeah, are you sticking around? You're getting an upgrade.
I am. So Andy, your time here is done, but mine is not.
No, well,
Yasser,
good times fly quickly. So that was
Yasser and
a
I
really good show.
We're almost neighbors. We live in the same neighborhood, so it's just like one of these days we should just do it together.
You'll be hilarious.
In fact, we should have coffee and have it like kind of a round table
live show. Exactly.
That would be nice.
Yeah, that'd be great. Andy, you have a great weekend, my friend, and we'll see you sometime soon.
It was a pleasure. Have a great show, you guys.
Thank you.
Cheers. Have a great weekend.
Take care. Happy Friday.
Yasser. Hey, buddy.
How's it going?
It's good. It was amazing with Andy. Yeah. And now it's just as amazing that I get to spend this last hour of Fool24 for me with you.
Well, yes, I'm sorry to disappoint our viewers. It is a definite downgrade, no matter what Andy says. But I'll try my best. I'll do my best. I
feel the same. I really, really do. That's why I like doing shows with them, because it really lowers everybody's expectations for me. Yeah. So, but this is going to be a good hour. So this is our usual valuation hour, Fools. So if you have valuation questions, get those in. But they don't have to be valuation questions. We'll answer other questions too, right, Yasser? We're not going to be mean.
No, I mean, this is we have a free policy here of accepting questions no matter what they're about. So
that's right.
We're here to talk about valuation. If you fools want to talk about valuation, but otherwise we're open to anything else you have on your mind. And,
the good things Go ahead, Yasser.
No, I was gonna say, and if you want, Jason, we can even start the discussion by talking about maybe some of our personal favorite metrics for valuing a company.
Yeah, I think that is an excellent place to start. But before we do that, for anybody that's just joining us, that's taking the rest of the day off for work to spend with us, thank you for this fabulous Friday. Just a reminder, get questions to us at slido.com. The event code is Fool24. All one word. Get those questions into us. Anything we say, of course, always want to remind everybody, at least once an hour, this is not individual investing advice. For a litany of reasons, we're not providing individual investing advice, nor would you want to from two people who you've never met with that don't know your financial situation and your needs. So we're happy to give our insights, but remember, it's not individual investing advice. So I'll kick it off then, Yasser. I think when it comes to valuation, the numbers that I think are the most useful across the board are cash flows based, free cash flow and operating cash flow, even for companies that aren't generating it yet, that are still negative, because these numbers can tell you a lot based on the direction that they're moving in.
Interesting.
I'll start there. What about you?
Yeah, I mean, I think, we also have to kind of keep in mind, and I absolutely look at cash flow valuations, including free cash flow and operating cash flow. Maybe I even prefer operating cash flow a little bit more.
I do too. Yeah.
Because it kind of captures kind of how
you don't have the lumpiness that you can have based on capital expenditures and all that.
Absolutely. 100%. So that's definitely a really good one to look at when considering, the multiples that you're willing to pay for a company. I do look at other metrics. I think that we also have to keep in mind that when we look at the valuation metrics for any given company, the sector in which the company operates is important to understand. That, some metrics are more critical for some industries than others. So, for example, price to book would always be relevant for a financial company, not necessarily so with a technology company. You would have something like enterprise value to, EBITDA, earnings before interest, tax, and depreciation, amortization. That's pretty critical for an industrial, for example, but maybe less so for other industries. That doesn't mean that's irrelevant. It just means that, if you're an industrial company, you really want to, I like to make sure that I'm getting, a good deal on that metric, as opposed to maybe, another sector that maybe I'm not, as strict about that.
No, I think you're spot on with the importance of understanding the implications of the different industries that companies follow in, because I'm going to use two companies as an example that are vastly different and the profiles of the businesses can be different, are very different, but in terms of the economic results they can generate can still be wonderful. Thinking about, say, O'Reilly Auto Parts compared to Microsoft,
yeah,
for example.
Yeah, very different businesses.
Very, very different. Different margin profiles, different operating expenses, different cyclicality, all of those things. But we could just start with the margins. Two businesses that have incredibly different margin profiles.
Correct.
And the way that's, and to be specific, exceptionally high margins from a software business like Microsoft, incredibly high margins on the growth side, moving down through their operations and then to their profit margins, net margins. And you see pretty decent gross margins from a business like O'Reilly. But then you start moving through operating to get to their net margin, their profit margin, and it's much, much smaller.
Sure.
But a business like O'Reilly can be successful with those lower margins just by being really, really good at turning its inventory really, really quickly.
Exactly.
And you can see why it trades for higher multiples than its peers and why it has been a massive winner and a more profitable business than its peers, because they figured out how to be really good buyers of their inventory, how to manage their inventory really well and turn it much, much faster and turning it into cash much, much faster.
See, a lot of investors actually make the mistake that if a company operates in a sector with really high gross margins, for example, that automatically means that it's going to be profitable, that you can just invest it and it's going to be a winning investment. That's not necessarily true. In fact, a lot of times, I'm definitely looking at you tech here, a lot of times companies with these really lofty gross margins that are just so admirable, right? They struggle to become profitable because they're just, honestly, they take a lot of things for granted. Funding has come for many years, over a decade, at near 0% interest rate. And therefore, the combination of fast top line growth, high gross margins has made a lot of these companies kind of almost lazy. They've kind of just not necessarily pursued that efficiency that you're talking about. That a company with a lower gross margin and in fact may not have that luxury. They
had to learn how to be disciplined from the beginning.
Exactly. They have to work hard day and night from day one to eke out a profit on a low margin business. And
the teenager whose parent does its laundry maybe looks good as a teenager,
right?
But the teenager whose parent doesn't do their laundry probably looks better as an adult.
That's a very wise saying, Jason. I'll add it to my my book of sayings because
there you go.
And I can relate to it personally. Same. But we're not gonna get into that right now. So it's like O'Reilly is a good example. This is a company with great track record of capital allocation, of being efficient, working on economies of scale to some extent. And being able to build that competitive advantage. And the benefit that you have in some of these companies, like if you're looking for multi-baggers in particular, that if you find these companies early enough, right, they often have a very, very low valuation multiples. That the market is so suspicious, about them that they tend to trade at fairly low valuation multiples. However, once the market starts seeing that these guys are delivering their earnings, beating and being profitable and growing, year in, year out, they start awarding them with a higher multiple. So you get the double effect of earnings growth and multiple, multiple inflation, I guess.
Expansion.
Expansion. Yes. Thank you.
Right.
Multiple expansion. So once you have these two engines, at work, that can lead to some spectacular long-term returns.
No, that's exactly right. All right. Well, let me ask you. I'm gonna ask you a question here.
Yes.
This is the multiple. Let's touch the let's touch the third rail here, and let's have the
boy.
psychological conversation about price to sales as a valuation metric, and how you think about it and how it can be useful.
Okay.
So I'm gonna let you go first.
Oh
and
boy!
then I'll weigh in.
I knew that. I knew you were gonna get me with a gotcha question.
No gotcha moments here. None whatsoever.
Price
No
to sales. Okay, so I think that price to sales can be indicative, right, of certain things when it comes to high growth, especially tech companies. It can tell you how much investors are paying at this point for the sales growth of any given company. Now, is this my favorite metric? Absolutely not. Because why? Because it doesn't really tell you that much. It doesn't tell you, first of all, if the price to sales rate, ratio in this case for a tech company is low. Well, does that mean that the market doesn't believe this company is going to grow for very long? Or what else are we missing here? So that raises some questions. But the second reason is sales growth in itself, while a very good thing, is not the end of the story. In fact, and we have seen this with some companies, sales growth can be as much value destructive as it is value accretive. So unless you are adding value to your business by growing it, you're actually kind of like stealing from what's the saying? Stealing from Peter.
Robbing Peter to pay Paul.
Thank you. Robbing Peter to give Paul. So so you have to be careful, like with a lot of things here when it comes to sales growth with some of these high growth companies, especially if they're not profitable. Are they actually, do they have any operating leverage, or is it costing them more to grow sales, right, than if they actually hadn't grown sales? Like maybe they would have actually been better off not growing sales at all, because they have to offer all these incentives. And I recall one of the perhaps most notorious examples of this kind of model was this little e-gaming company, esports company called Skills. I don't know if anyone remembers it. It was kind of a very brief flash in the pan pandemic darling. They were literally paying people to go on their platform. Literally. Right. I mean, you could, like, and then they would kind of like, they would give people money to spend on their platform and then recognize that as revenue, if that makes any sense.
Yeah, no, I remember the whole thing was just kind of bananas.
Right. It was deeply, deeply suspicious. Let me put it that way. Something didn't smell right. So, so that's kind of, like why I sometimes hesitate with price to sales.
No, and I think that's it's an approach that's generally kind of aligned with how I think about it. I've said before that price to sales is a little bit like empty calories when it comes to valuation. If it's the metric that an investor is using to justify, or the only metric that they're using to inform a decision, there's a lot of things that are being ignored.
Absolutely.
And it's probably being used to justify something that your bias is telling you to do, not that you're trying to arrive at the best decision, right? So I definitely use it in the cases you were talking about to augment the way that I think about investing. In companies where we're still they're still somewhere on that cash flows journey, where we need to see better. Like, for example, CrowdStrike. There was a period of time after it went public that it was still burning cash. So when a company has negative free cash flow, you can't really get a price to free cash flow based on its current results. You have to start projecting to get, doing a discounted cash flow to try to arrive. And you're doing a lot of guesswork. But you can use a price to sales multiple looking at high growth, large, medium peers, other software companies that have similar profiles, financial profiles, operating profiles, to inform what that sales multiple would be a reasonable price. So it can be useful to inform your decisions. I agree with that completely. So, yeah, no, you passed. That was a good answer.
All right, thank you.
All right, you want to take Ed's question about CrowdStrike?
Right, and let me just share my screen right now because I wanted to show some of these valuation multiples for the company that we are looking at, which is CrowdStrike. So Ed asks, Crowd reports next week, very expensive stock. Would you be surprised if it goes down 20% after earnings? And now let me sorry, I had to read the question there. All right, so let's look at the chart here of CrowdStrike. We are looking at EV to sales of 24 times, EV to operating cash flow of 50 times, forward P ratio of 87, EV to free cash flow of 82. So the short answer is yes and no. Yes, I wouldn't be surprised because, or would it be? Yeah, I mean, I wouldn't be surprised because when you are as richly valued as this, if you disappoint on your earnings call, and that could be not just by failing to beat and raise. In fact, you might be, failing to beat on the top and bottom lines. You may still beat on the top and bottom lines, but if you issue weak guidance, for example, that comes well below what the street expects.
The trade desk is an example, right?
Exactly. You can expect a very harsh reaction from the market. And, you know, any stock or any company that trades as richly as CrowdStrike does, if it fails and, you know, to meet expectations on its earnings calls, you can expect a big drawback. However, having said that, I don't know. I feel like CrowdStrike has not been in the habit necessarily of disappointing investors greatly.
Yeah.
And has been a very high quality business. They have very high revenue retention rates. They've been able to kind of continuously invest in their platform, keeping it at the forefront of cybersecurity and continuously updating it with newer modules that they are able to upsell their customers on. So they have both the growth leg of adding new customers as well as upselling current customers. So all of that combines to create a pretty high quality company. So I'm sorry if I'm not committing to a single answer here, but I would say that it can happen. But
well, if you were committing to a single firm confident answer here, I would call you out on it because you'd be you'd be making a prediction about something that you have no ability. And Yasser, you are a very talented investor. I want to be clear there. None of us have the ability to predict with any precision what's going to happen with these companies and around earnings, right? So good answer, I think, is what I wanted to say. You know, I do tend to agree with you though, that I think, and I'm going to steal the screen share. I'm going to send up a different chart. Natasha, if we can do a swap out here. And what this shows here is the E is earnings for the company. And you can see the E usually sits on top of a little tiny mountain. Typically CrowdStrike delivers results that are good, maybe a little better than management's own guidance. And more important for what the stock is going to do is their guidance going forward is usually an acceleration of growth. Had been, at least until the past couple of years, where we've started to see growth still be incredibly strong, but it has decelerated a little bit. But the key is that guidance has been for continued growth in excess of the market's expectations. The one big sell-off we've seen prior to what we've saw recently was the outage.
Oh, you remember the Delta update? Delta Airlines?
Yeah, right. And I think what we've learned too is that Delta's problems were more Delta operational problems. CrowdStrike at one point, one of their executives pointed out that they have other airlines that they do more business with than they do with Delta, and they were fine. So you know, more recently, we've seen the price come down as a lot of tech, SaaS, AI stocks have given up some gains here more recently. So
definitely. Yeah.
Love the
Absolutely.
business.
Yeah, it's a great business.
Okay. What's next? Shopify. Ed asked about Shopify.
Right.
He asked about, it was interesting. I think he was setting us up for this hour. He asked this question at the end of the last hour. Says Shopify is very pricey. I'm concerned going forward. Do you follow?
I do follow Shopify. Yes.
I love this business. I love it
It's
so much.
It's the best investment I've ever made in my life. So,
there you go. Okay.
So I better follow it. Yeah.
All right. Good.
right.
Good job. Good job.
Thank you.
It's one of my best investments as well. And I will say, so again, Ed's question, Shopify is very pricey, ticker SHOP. I'm concerned going forward.
Right.
I'm not.
Yeah.
Not concerned.
Yeah, I mean, I think it would help if you tell us why you're concerned. I guess like maybe you're implying here that valuation is a reason for concern. But again, this all depends on what's your cost basis for owning the stock, and what is your kind of outlook and how long you intend to keep the stock, right? If you feel like you're going to need to sell the stock, anytime less than, I would say 3 to 5 years, you should probably you can be a little uneasy about the valuation. But this is again, I'm going to repeat what I said about CrowdStrike. It's such a high quality company. I mean, fools, let's remember just how unbelievably difficult it is to sustain double-digit revenue growth rate for all these years, for as long as it has lasted, for both companies, really. It is not easy at all, because at some point you start hitting what we call the law of large numbers, right? Like your revenue becomes so large already that it becomes incredibly more challenging to continue the same pace of growth. And you and Andy were just talking about Axon and the previous segment. That's another company also that I would put into that basket. Again, companies that just keep growing. And the reason they keep growing is because of management. It's because they have the right people in place who are invested in the business, both personally and kind of intellectually, where they keep, they keep trying to stay ahead of the time, right? Like they always keep an eye out where the next leg of growth is going to come from, where's the next S curve of growth, and we need to be investing in that today, even if it's coming out a couple of years from now or a few years from now. So I give the example of CrowdStrike, how they keep rolling out new modules that tech teams love to augment their cybersecurity capabilities with. Shopify has kind of been the same, and a lot of of the growth for these companies has come organically. By the way, these have not been acquisitive companies that have gone and blown up a lot of cash on buying other expensive companies in pursuit of growth. Shopify has been able to continuously roll out new features demanded really by the market, that the market needs, that those merchants, especially the small size sellers on the platform, they need everything from back office accounting stuff to marketing and promotion to credit to even sometimes offline solutions, and Shopify has been just offering more and more and more. And the last thing is now AI, basically having an AI assistant for a small e-concession owner or a small seller, that's really critical. These people have a lot of work on their hands. They don't have a lot of time. They can't afford to hire people to do their work for them most of the time. So providing that AI assistant that helps with things like marketing, with even promotional messaging, that writes them for you so you don't have to do the guesswork, maybe ad placements, stuff like that. That's really, really important for a lot of sellers out there. And Shopify has always been kind of, saying that they used to say that Shopify is arming the rebels, against the empire that is Amazon. So you have all these, sellers, but there's so many of them now that they has constituted really a critical mass.
I want to build on a couple of things you were talking about.
Sure.
I don't think you can really emphasize enough how critical and how sticky Shopify's platform is. You were talking about the expansion and comparing it to CrowdStrike. It's so funny because, I think we mind melded a little bit here, because I was thinking the exact same thing before you said it.
Right.
Is that they continue to add tools that small merchants need. And it's not just small merchants either. There are a lot of big brands that use Shopify as part of their omni-channel platform and how they sell online. But the full integration is the key. And just in the same way that a Toast is providing these tools that a small restaurant can use that are worth, dozens to 100 hours a year of savings of time trying to work on their business when they want to be working in their business. That's exactly what Shopify provides to their merchants as well. And if you just look at, for example, you can look at like the growth in GMV, gross merchandise volume, which is the total value of all the stuff that the sellers are selling.
Yep.
Versus the growth in Shopify's revenue. Shopify's revenue is growing at a faster rate. What that means is that its customers are finding it more and more valuable because they're spending more money to do more things through Shopify, with Shopify in their businesses, than the revenue that they're doing with the company. So I want to highlight that. I think it's incredibly important. And since this is the valuation hour and we're talking about a fool that, like other fools, has seen the stock do well and it's concerned about valuation,
right?
We're seeing the economic results play out. Last year, the prior fiscal year, 2023, free cash flow margin was 13%. In 2024, free cash flow margin was 18%. That is a massive increase.
Yeah, that doesn't come easily.
in cash profitability. Right. It doesn't. Here's the thing. It was 18% for the full 2024. You know what it was in the fourth quarter? 22%.
Wow.
Another 4 percentage point increase. So we're talking about unlocking the economic potential, that operating leverage. And to put some numbers to that, trades for, what does it trade for price to free cash flow? Let me look that up real quick here. Price to free cash flow is about 90 times, roughly 90 times price to free cash flow.
Yep.
If we see that 18% free cash flow margin from 2024 turn into the 22% or better, likely better free cash flow margin that we saw in the fourth quarter, immediately, what's the difference between 18 and 22? 4 times 4, 16. It's 25% better, right? Immediately, the stock on a multiple basis is 25% cheaper than that 89 times that we're seeing. Just that one thing, just that one little thing. Again, looking backwards and then looking forwards. So the stock is cheaper than it might feel. Number one, 1A, did less than $9 billion in revenue last year. I don't want to compare this to a MasterCard or a Visa, but I'm going to. With the revenue numbers, MasterCard did $28 billion in revenue last year.
Right.
I want to say that again. MasterCard did $28 billion in revenue last year on a take rate, right? For providing the rails for the economy, for part of the economy.
Yeah. That's Shopify, not even the TPV, like the total processing volume. That's just
right.
Yeah.
So it's a tiny fee compared to the take rate of a Shopify that does so much more for its customers, including now things like Shop Pay to make it easier for people to do business with Shopify platform customers. I love Shop Pay, for example, like clicking that button, but it's not having to put in my information and stuff, and it just happens. I love it.
And I think they actually revealed that, if I remember this correctly, that having the Shop Pay option for sellers leads to 50% more conversion, more, or like as in people, check out of their carts, they complete the sale.
Yeah.
50% more likely to do that than if they have to fill out their credit card information or to use a different type of checkout mechanism.
It's powerful. Well, and it's expanding. That GMV through ShopPay grew 50% last year.
Right.
It's working, and people like it. The merchants are liking it. But here's my point. My point is thinking about the addressable market, the size of e-commerce globally, not just e-commerce, commerce, integrated commerce for these businesses. The percentage of that Shopify can get based on all of the things that it does for its business, its customers that create value, that they love and appreciate, versus a Microsoft that every small business owner you will ever talk to, every merchant that you ever talk to will tell you that they hate MasterCard and Visa and American Express and Discover because they basically take about half of their margins, the fees that they charge. Shopify has the ability to get substantially larger than it is today. As much as it has grown, it has the ability to get substantially larger than it does today. And that's because part of the margin of safety for investing in a company like Shopify is my ability to hold it while it grows into its market. Some stocks you buy because they're cheap and you're expecting multiple expansion, right? Like the deep value opportunities. Some stocks you buy because their ability to become much more valuable because of a massive market that they're winning in and that they can grow into.
Right.
That's why I'm thinking about Shopify. I have zero concern about Shopify over the next decade.
Excellent thoughts there. And perhaps, I would tie it into Ed's question where he says many members are concerned about valuations because we bought maybe within the last 2 years, whereas the hosts may have held these stocks for 5 to 10 years. I'm going into 11 years on Shopify personally. So it's a very valid question. But here's what I'm going to say. Valuation, as important as it is, becomes much less relevant the longer you hold the stock.
Yeah.
What matters a lot more is earnings quality, management, and, durable growth, basically. If the company is able, if you see the company being able to hit the mark on all three, or at least two of the three, you're likely to be paid back in due course. Obviously, there are no guarantees in investing and things can go wrong. But all I can say is the longer your investment horizon, the less worried you should be about valuation. And again, that doesn't mean that you should sell everything and bet it all on one stock or one company just because you think it's it meets these criteria, even when it's as expensive as it seems. It's just maybe you want to take a measured approach. Maybe if you consider a stock to be expensive, you want to kind of build a position slowly over time as opposed to going all in at once, just to mitigate that risk.
So Yasser, if I may, I want to push back. I want to push back a little bit. Not on you, but I want to push back on Ed a little bit. It's easy sometimes to project and those sorts of things. And in your situation, talking about how this is one of the best investments you've ever made, the best investment you've ever made. You've held it for a long time. I'm also fortunate that Shopify has been a wonderful winner for me. And I did make some investments 2018, 2017, 2018, somewhere on there. They've done exceptionally well.
Right.
I've logged into Fidelity. I'm looking at it on the screen, so I apologize if I'm not making eye contact via camera here. I bought Shopify, a substantial amount of Shopify I want to add too. December 13th, 2024. I bought a little bit before that in October of 2024, a small position.
Good call.
So again, yes, I have some long held positions that have done really, really well. But if there's one thing that I have learned, that is the most important part of my investing success,
Add to your
is adding to your winners. Exactly. That's exactly right, Yasser. That is exactly it.
Sorry, couldn't hold it back.
No, it's beautiful. We should sing a duet about it. It's wonderful. It's wonderful. So, Ed, thank you for the question. I understand the concern.
Right.
When you have a stock that's tripled in 2 years.
Yeah. I mean, look, this we have this problem. Like, this is a very common issue for investors, including myself. Nobody's immune from it. And it's called price anchoring.
Yeah.
When we buy a stock cheaply, it is so hard to get us to add to that position after it has doubled, tripled, quadrupled, or in this case, may have more than 10x.
Yeah.
So,
right.
People usually resist that. They think, well, I already got it when it was blah, blah, blah. I can never buy it right here. And it also works even more tragically if you did not buy it early on. You had looked at it when it was, let's say, $20 a share, split adjusted, and you passed on it because you thought it was too expensive. And now it's $120 a share. And you're like, well, there is no chance in the world I'm going to pay that $120 after I passed on it when it was $20 a share. Again, that doesn't tell me anything. If you cite the share price, that doesn't tell me anything. You have to put everything in context. You have to know, what are we talking about in terms of valuation multiples? What are we talking about in terms of expected growth of earnings, expected growth of cash flow, expected growth of revenue? What are we talking about in terms of, again, management quality? All of these things together, come together in order to kind of like give you kind of a better picture of what an investment should look like.
Yeah, I want to. There's one more piece of context that I think is useful too. And again, Ed, I don't know about your individual situation, but there's a good chance that, like a lot of us that were buying stocks in 2022 when they were cheaper than they've been in a long time. Right. We had a really good, that spring through October was a wonderful opportunity to be buying some stocks that were really beaten down. They were down a lot, right? We remember 2021, right? When it was really October, when the market peaked for a lot of these stocks that fell 50, 60, 70% or even more before we saw the rise of, the fall of 2022 when the stock started to gain again. So that anchoring that you're talking about, there's recency bias as well, where we can easily think, well, stocks are up a bunch, but they were down a bunch before that. So I need to get out now because they're just going to be down a bunch again soon. And you zoom in and you look at these periods and you can see when a stock fell a lot, and you look at any great stock over the long term, you can find periods where they fell a lot. The Quickster disaster with Netflix, for example, some of the post Steve Jobs challenges that Apple dealt with, where growth was kind of slowing down and investors were very unsure that they had the right CEO to replace him, which we've learned is they sure got a good one now. But you can find it with every company. Look at Nvidia. You can find plenty of times that stock lost more than half of its value. The point is, when you zoom back out and you look at these massive winners over the long term, it gets really hard to find those dips. They look like little speed bumps. So when you climb a mountain, you take a rocky path to get to the top.
Yep.
But when you get to the top and you look back, it's a pretty amazing view. And you forget how hard it was to get there. Yeah. And sometimes the hard part is getting through the volatility. So often it's the hardest part.
That's the hardest part. Not everybody can stomach, my Shopify position at certain points, I think, was down 30, 40%. And at that point, it had already become a sizable portion of my portfolio, to the extent that my portfolio was getting jerked around pretty wildly based on how Shopify moves. And I know not everybody has a stomach for that, and not everybody, is comfortable with allowing a single stock becoming, a big part of their portfolio. But in my case, I am. but I had to sit through these periods of time without losing my temper, without kind of like panicking and saying, you know what, I can't take this. This is too much. It's too risky. I'm selling everything. Why? Because I believed in the company and I believed in the, where it's headed and how things are going to turn out. So anyway, we don't want this to be the Shopify hour, but these are kind of like my thoughts on the.
No, it's well, I mean, I think within the context of thinking about valuation, if valuation was simple and easy of finding a cheap price to buy, and then when the multiple is expensive, you sell,
I know
there'd be a lot more wealthy investors. But it's there's more to it. There is. So that context is useful.
Absolutely. And I'm just gonna go ahead and say it. I do pay attention to valuation, but I'm not a value investor.
Yeah.
I am not the type of investor who will see a company like Shopify and say it's too expensive for me. I'm going to go with eBay because it's a lot cheaper. For me, I'm willing to pay more for the quality and for the growth prospects, especially if they are durable and sustainable and seem to be long term. So, yeah.
All right. So we've got a question. Andy asked about Intuitive Surgical, tickers ISRG. Let's leave this one in the queue because I think we've got some folks coming on later
for the health hour.
That can dig in a little more on healthcare. But this is, I wanted to mention it, Yasser, because this is in terms of percentage gains, not total dollar returns, because I never made a substantial investment in Intuitive like I have in Mercado Libre and some others.
Right.
But percentage gains, this is the best stock that I've ever bought. Nice. Andy's question is thoughts on building a position here. Thinking from valuation, I will say this: it has come down, but I do think it 85 times operating cash flow with a lot of potential to grow. But we're talking like mid-teens growth, not the kind of growth rates we can see from some of these other companies, and a far more mature business. If I were looking to buy Intuitive, I would view right now as nothing more than maybe add a small amount or start building out a position. But I don't think right now is a time to make sizable investments in it because it continues to trade for an extreme premium to its long-term multiple. So I think there's other places to put cash instead.
Yeah, I don't know enough about the company. I don't follow it closely. I know it has been a long-term winner for a lot of fools.
Wonderful business. Yeah.
Great compounder, great just innovation, really. They have completely revolutionized the field of robotic surgeries with the Da Vinci system.
Yeah.
So,
the next iteration of that's out now is incredible. Like the precision and the feedback that it gives to surgeons is supposed to be just remarkable. And I think the biggest thing they have now, Yasser, is that they've built a moat.
Yes.
Of an entire generation of surgeons.
Absolutely.
That this is how they perform their surgeries.
Absolutely. And it's such a defensible moat too, because you don't want to mess around with surgeries. Like, if a surgeon knows that this machine works, he has no incentive to go ahead and buy a slightly cheaper alternative machine that he had never tried before, that he hasn't seen other surgeons use, and try it out on a patient.
No, exactly. Yeah. Well, and they continue to build on the kinds of surgery that their robotic surgeries, their devices, not just the. You just said the name, and now I can't remember. The Da Vinci.
The Da Vinci system. Yeah.
They're building other systems as well that can do other kinds of surgery. So it'll be interesting to see that continue. Okay. You see one you want to grab next year?
I saw this question from T Stock.
PEG ratio.
Yes. Thoughts on PEG as a valuation method. PEG, for those who may not know, is price to earnings growth. So how much are you paying when you buy a share of this company in terms of in relation to the growth of the company's earnings?
Right.
Jason, do you have any thoughts on that?
I have a lot of thoughts on it. I'll try to keep them limited.
I know, by the way, PEG ratio is a very controversial ratio
Yes, it
for a
is.
lot of investors. It first became, I believe, very popular with one Mr. Peter Lynch, who kind of introduced it into like kind of the public sphere, or I mean the investing pros knew about it from before, but in terms of individual investors who learned a lot from Peter Lynch,
he released it into the wild.
He released it into the wild, and his he had a very simple idea, if I remember correctly, which was that buying a company at less than 1 times PEG ratio means you're getting a great deal.
Basically, it's like this is the way to buy growth for a discount. So here's what the PEG ratio is, like if you look at it, so you know what you're looking at. In a way, it's kind of like beta, where 1 is like average. So a stock with a beta of 1 is a volatility that's the same as the index, the market, right? If it's below that, it's less volatile. If it's above that, it's more volatile. PEG ratio is the same idea. 1 is like, this is fair value, right? It's kind of the idea. It's like you're paying a fair value rate. If it's below 1, it's cheap. If it's above 1, it's more expensive. The challenges with PEG is similar to thinking about price to sales. Using it in and of itself, or using it as the reason to act, ignores a lot of context, and isn't likely to be. Let's be honest, Peter Lynch was pretty good at his job last I checked, but he wasn't making final investment decisions based on PEG ratios. I promise you, he wasn't. It was helping him build a list of businesses to then do further research and to reach a decision.
Right.
The challenges that I have with the PEG ratio, number 1 is when you're talking about future earnings, you're talking about estimates.
Right.
Even Peter Lynch didn't have a crystal ball that told him what companies were going to earn next year.
Right.
The other aspect that's challenging is that earnings estimates are adjusted. Analyst estimates, Wall Street analysts, they're always adjusted. They're not following GAAP earnings.
Right.
So with that one thing, they're automatically inflated versus GAAP earnings. So you start thinking those things through when you're going on the best guess of Wall Street's finest adjusted results. You're operating with information that you have to be very careful with. So I've never found it to be particularly useful or informative. Other fools have. I haven't. What about you?
Yeah, I mean, I will take a look at it if it's available, but that does not necessarily inform my investing decision, or does not necessarily decide my investing decision. It's kind of one of those things that help you catch a glimpse on part of the story, but it doesn't really tell you what the story is. So
exactly,
you have to and please, fools, be very suspicious of anyone who comes to you and tells you there's this one ratio that if you get right, you're going to get the investment right. It doesn't work that way. There are often so many different variables and factors at play that all investors need to pay attention to before making an informed investing decision.
Yeah, no, that's exactly right. And that's the key. It's using multiple metrics along with the story of the business, along with the trajectory of the business, thinking about the addressable market, its peers, the opportunity and risk, all of those things together to arrive at the closest thing you can get to the best decision, versus using any of these metrics just to justify what you already want to do. That's what we do, right? When we make mistakes, we've already decided what we want to do. And as soon as we see a metric that says it's the right thing to do, it's like, okay, now I can do it. So that's the risk to me.
Yeah.
All right.
We have a question here from Matt asking, how attractive does Wingstop's valuation look? Okay, I'm going to, again, share my screen real quick. Okay.
I will say, full disclosure, as you're pulling that up, and our wonderful producers are sharing that in the background. there's a very good chance I will be eating me some Wingstop here in about 2.5 hours.
Nice.
Yeah.
Nice. I used to love Wingstop sandwich. I mean, I love their chicken sandwich, to be honest. One of my favorites. I also love their wings. I can no longer eat them. I've been warned by my doctor. Very high cholesterol levels, so
yeah.
I can admire it from a distance.
There you go. There you go.
Yeah.
I promise to not tease you and send you photos of me eating wings later.
No, please do. That's how I enjoy it vicariously now.
There you go. Okay, fair enough. All right, fair enough.
But anyway, so here we're taking a look at some of the valuation metrics when it comes to Wingstop. We're looking at EV to EBITDA. That's kind of enterprise value to effectively operating income of about 39 times or 40 times. We're looking at EV to sales of 12 times, PE ratio, forward PE ratio of 62 times. And if we add, let's see, the cash flow from operations,
about 44.
Yeah. It's showing it here as 57, but that doesn't look updated. So maybe you have the most updated numbers. All right. So yeah, I mean, compared to where it was trading over the past year, it's cheaper, right? We can say that. Is it cheap? No.
But as long as they continue to deliver the results they've been delivering them, the stock's not going to get cheap.
Right. And that kind of brings us back to the same story we've been having with CrowdStrike, with Shopify, and Axon. Wingstop, in my mind, is a very good company. They have a very good business model where virtually all of the stores are franchisees. They are not owned by Wingstop, which gives them a pretty good margin profile compared to other restaurant operators. The typical franchisee of Wingstop would make back their investment in the first year of ownership.
Yeah,
that's incredible.
That's a unicorn in the franchise restaurant world.
That is absolutely incredible. The Wingstop has also been very technology focused from day one. They have really invested very much in their app and their website, in the delivery mechanisms, and a lot of the back office stuff. They have been technology first, unlike a lot of restaurant operators as well. And that does give them a tremendous advantage especially in terms of like being able to grow the business and profitably do it. So, I like the company. The stock is not cheap. It's better priced now than it was a few months ago. That's what I would say.
Yeah, no, I think you're right. And taking a little step further, thinking about valuation, where the business is today, you don't buy a stock based on how it's going to do tomorrow or next quarter. You're thinking over the next decade, if you want to think about it. Yeah. And Wingstop's position to continue growing, where this valuation, I think, probably works out over the next decade to a pretty good environment or a good economic return. I really do. All right, so we got about 5 minutes left, and we've got some more questions that have come in. Roger asked 25 minutes ago about the trade desk. Oh, you still got your screen share up there, Yasser. No problem. Asked about the trade desk. Since the trade desk is becoming realistic, would you consider buying? Fools, I will tell you what I have already done with the trade desk. I have a pretty sizable position that I've had for a long time. One of those rare winners. And I've added to it over time. And I'll foreshadow another question that we'll answer, thinking about adding and looking at valuations. As you average up on the stock, sometimes you average down on the earnings multiple. So I reached a point where I don't necessarily want to own a lot more trade desk than I do. I don't want to invest a lot more capital into the trade desk. I want to own a lot more because they win, right? The stock price goes up.
Right.
Without a little more clarity on some of the challenges that the business is facing. So what I mean by that is Jeff Green told us unequivocally when they put out their guidance is that, and if you go a little back prior to the hour I was on with Andy, we talked about it a pretty good bit, about how have failed to deliver a little bit on one of their newer products. And I want to see them do a little more to answer some of those questions in coming quarters. So I chose to use some options. A lot of times people think of options as like a risky way to invest. It can also be a way that you can lower some risk of losses as well. So I use some put options that if the business does swimmingly, the shares won't get put to me, but I'll get the premium. I'll make a little bit of money on the premium. But if the stock recovers and moves even higher, then I won't get those shares. I use some of that premium to buy some call options that give me, I sacrificed a little bit of that like potential best case profit to buy call options that in that best case scenario, the call options will work out really, really well. But in a worst case scenario, I would be buying more trade desk for below its current price, but paying a little bit higher price. So that's what I did. I do think right now is an attractive buying opportunity for the trade desk, but not buying a lot. I think the business is built to do really well, but it's a good time to maybe add a little bit to a position or maybe start a position, but let the business deliver to continue earning that, because they do have some challenges right now that I think that we need to see them resolve. Any extra thoughts, or you want to ready to grab another question?
No, I'm good.
Okay. All right. Let's see here. Where was that other question?
Okay.
So DG Dollar General, is that
no, that's David Gardner.
David Gardner. Oh yeah, thank you. Yeah. Okay. I was like, that's not Dollar General.
Yes.
Buying on the way up. So Jimbo has a question that says DG David Gardner, buying on the way up. Do you look at valuation relative in time? Do you buy if multiples go up? How do you decide a stock should warrant higher multiples? The way I think about this one in terms of averaging up on the stock price, I've talked about Microsoft or Mercado Libre and Trex, two long-term winners that I've owned for a long time and added to multiple times. I've almost always averaged up, but paid a lower multiple every single time, whether price to earnings or cash flows or whatever. So that's how I've always approached it. So my question, I want you to answer, how do you decide a stock should warrant higher multiples?
Well, to warrant higher multiples, that means you're performing much better than expected, and you're outperforming peers in your industry. So you have to be best in class to warrant higher multiples.
Home Depot versus Lowe's over the long term is an example.
Correctly. Yes.
Yeah,
absolutely. Or maybe Costco over Dollar General. since we have the DG here.
Boom, there you go. There you go. Love it.
Right. So I mean, if you're doing better than expected, you're performing, and you're best in class, you absolutely deserve higher multiples.
Yeah.
And there's nothing wrong with that. I mean, this was like probably Munger's best contribution into the Warren Buffett universe.
Absolutely.
Right?
Absolutely.
You pay for quality, it will reward you.
Yeah, no, that's exactly right. There's almost always a reason why a stock in an industry trades for a higher multiple and why its competitors trade for a lower multiple. Yeah. And buying the lower multiple almost always will result in a mediocre return.
Right. Yeah. A lot of investors, are attracted to the idea of buying a value investment just because, well, it's cheaper. That means I'm definitely getting a good deal. Not always. Right. You have to be discerning. And sometimes it's cheaper relative to another stock. Sometimes it's cheap in absolute terms. Sometimes it's cheap relative to its own historical multiples, in which case you have to understand why it is cheaper to its own historic multiples, right? So, you have to ask a lot of questions just before going off on any single metric, as I said before.
Well, it's the craft of investing versus just following hard rules about these sorts of things, and using the right approach with thinking about multiples and valuation based on where the company is on its journey. I think that's really, really important to remember too. Yasser, I think our time here is done.
Yeah, I think they're ready to kick us out.
They are. So fools, I want you to hang out for just a second. We're going to be pausing the live stream. You'll see a little video come up because we're going to be joining our YouTube viewers into this before we shift into the earnings hour with a couple of new fools. But before we do that, and before I say fool on, Yasser, I want to wish you and your family a happy Ramadan. Enjoy the feast you have this evening.
Thank you, Jason. I really appreciate it. Technically, the fasting starts tomorrow, so I'm not particularly looking forward to that part.
That's the hard part.
I know that's the hard part, but I really appreciate it. And happy Ramadan to fools out there who are either observing or just, wishing us a happy Ramadan.
Cheers. Appreciate that very much, friend. All right, fools. Again, stay tuned for a little video, and then you'll be joined with the rest of our new fools in the making from YouTube as they join us on the live stream. Until then, Yasser and I say fool on, and we hope you have a wonderful weekend.
Fool on.